Here in New York City, I'm Shauna Smith alongside Brad Smith, and this is Yahoo Finance's flagship show, The Morning Brief.
Good morning, everyone. Let's get to the three things that you need to know today, starting with the markets. Stock futures looking to bounce back after a tough week for the equities market. The S&P 500 saw its worst week since March of 2023, and the Nasdaq Composite had its worst week since 2022. Nvidia and the chip sector, they were a big laggard on tech. Nvidia off more than 12% over the last 5 trading days. September is traditionally tough for stocks in this month. Wall Street is awaiting a final inflation reading ahead of the Fed's September meeting as well.
And Apple's iPhone 16 officially launching today. The tech giant is holding its annual iPhone event at its Cupertino, California headquarters. We're expecting to announce 4 new iPhones along with new AirPods and a 10th anniversary edition of the Apple Watch. Apple is also expected to roll out Apple Intelligence AI platform that will be for the iOS, iPadOS, and macOS. This is one of Apple's most important events of the year and helps set the tone for the year ahead. Since January 1st, Apple shares are up just about 14%.
And staying in tech, Google is back in the legal spotlight today. Yikes. As the company goes on trial for the second time this year over monopolistic charges. Prosecutors and lawyers for Google are expected and scheduled to give those opening arguments today in federal district court in a case that claims Google illegally maintained its dominance in 3 markets within the ecosystem that automates online advertising. This case was brought in January 2023 back by the Biden administration's Department of Justice, along with 17 state attorneys general. And it comes just a month after Google suffered a defeat in a high-stakes federal antitrust case brought by the DOJ under former President Trump.
Let's kick it off. Let's kick it off with futures this morning, coming off what was a very weak market, a weak for the market here. We're taking a look at a bit of a different picture here this morning, a bit of a rebound, if you want to call it that. I guess investors finding some reason to be a little bit more optimistic as we start off the week. We'll see whether or not that carries through. You got the Dow futures pointing to gains here at the open. Taking a look at the Nasdaq futures, that's also showing some green on the screen here today, up as well as the S&P 500. Again, when you compare that to the action that we saw last week, a very, very different story. When you take a look at the S&P and performance here that we saw over the last 5 trading days, you're looking at losses more than 3%. I believe it's actually down significantly more than that. When you take a look at the Nasdaq 100, some of the losses that we saw there, that was off just about 5%, and I believe a little bit more than that. So you're taking a look at the fact that we did see much weakness across the board. A lot of the selling really for much of the week, but especially some of that weakness that we saw on Friday really has a lot to do with some of the declines that we saw in larger cap tech names. Right here on your screen, you're taking a look at Apple, Google, Microsoft, Nvidia, Amazon, Meta, those larger cap tech giants. They're all closing the day for Friday well in the red. You had Nvidia off just over 4%. This morning, though, a bit of a different picture, at least for most of these names. You got Nvidia on track to open just about 1% higher, as well as Amazon and Meta. And taking a look inside some of those semi names, specifically with all eyes on Nvidia here following their rout that we saw last week. Over the last 2 weeks, I believe the stock off just about 20%, erasing about a fifth of its market value. So here we are today looking at gains here, likely at the open, up just about 1%. So many investors trying to figure out whether or not we will see any return in momentum to some of these tech stock names. Of course, we're going to get key inflation data out later this week, and looking ahead to the Fed meeting next week, it could be in for a volatile ride here, Brad.
All right, quite a ride indeed. Tech stocks looking to regain some of those losses, as Shauna was mentioning, after the Nasdaq Composite logged its worst week since June of 2022 here. And Apple, one of the index's heavy hitters, is moving to the upside this morning. The tech giant will kick off its annual iPhone event in Cupertino, California later on this afternoon. And so for more on what we can expect from the event, we've got Bob O'Donnell, Technalysis Research President and Chief Analyst here. Great to have you here with us, Bob, to kick off the show. First and foremost, let's start with the big news that is Apple expected to come later today. New iPhones, Apple Watches. What is the product here, especially as it's usually the smartphone, that is expected to take the cake here, at least for consumers and investors that are paying close attention to where the stock may move thereafter?
Well, you know, the thing is, and I've been going to these Apple events for years and years. I'll be there again this morning. It's always been about the phones, right? The fall launch event is the big phone launch event, and people get excited about that, or at least they used to. The challenge is we're in an era when a lot of these iPhones look the same. This year's new versions are expected to be incrementally better, but not hugely different. I think, honestly, a lot of the focus is going to be on the Apple Intelligence AI features, because that's the exciting area. Like, what is Apple doing here? Of course, they announced some of this at their WWDC conference earlier this year, but the question is, how does it get implemented? What's it like to use? Does Siri actually become smart? And this is all important because Apple has said, look, if you want to use these new capabilities, you're going to either have to have an iPhone 15 from last year or the new iPhone 16. And of course, a lot of people are sitting on 12s and 13s and 14s. And so the question becomes, if these software capabilities are compelling enough to get those people to upgrade their iPhones, that's the market we're in these days. It's an upgrade market, right? That's where all the sales happen. So that's what I'm certainly going to be watching. But there are implications about this because most of the focus, of course, has been on the US implementations of these. We're not even seeing it happen in Europe, let alone China. And of course, there's a lot of questions about what AI capabilities Apple and others will be able to bring to China. So lots of questions, lots of interest, lots of excitement, but it's kind of more of a software focus, I believe, in the end.
Bob, how much of that excitement do you think has already been built into the stock or priced in?
It's a great question, Sean. I mean, to be honest with you, because of what I just said, most of this stuff, everybody knows what's going to be happening. I mean, who knows? Maybe they'll surprise us. Sometimes they do. I haven't gotten the sense that would be the case. And obviously they're going to have new watches, which has been a growing part of Apple's business, the AirPods as well, rumors maybe of an iPad mini, but again, that doesn't make or break things. So most of this stuff I think is built in. The question will be, has Apple cracked the nut on the ability to make AI useful for a lot of people? We've seen Google and Microsoft and others introduce AI-focused features, and they're kind of fun, but they're not something you're going to use every day. And in my opinion, Apple's really good at UI. Can they be the ones that start to say, hey, here's how you integrate AI, and normal people go, oh, wow, this is what I got to have. And so that's the part that could be the upside surprise.
Yeah, to partially quote Taylor Swift this morning here, Bob, I mean, it's me. I'm the problem. It's me. I have an old Apple Watch. I have an old 12 Pro Max iPhone. I haven't felt the need to upgrade. What percentage of the install base, though, do you think needs to be so enamored, so fascinated by some of these new features that might not come till later this year based on some of the OS delays that we had heard about? What percentage of that install base needs to be able to upgrade and take on new price as well in order for this to flow through to Apple's financial performance?
It's a good question, Brett. I don't know the exact percentages. I mean, there are a lot of numbers being thrown out there. But, look, we are in this era of 4-ish to 5-ish year phone cycles, just like you're describing, which would imply, there is only about 20% that have an iPhone 15, which means there's this huge 80% chunk that are part of what they want to see move. Now, they're not going to get all of that, obviously. And I'm not sure that this is a super cycle year that some people said, because again, we're not seeing a whole lot of hardware implementations. There's no foldable iPhone yet. Eventually, I'm sure there will be, but we're not there yet. That will trigger huge changes. So, it's going to be an interesting thing to watch. And again, the other question, as I said, is the other international side of this and what happens, how they deploy this in the EU and various countries there, and any regulations, of course, that may occur. And that's not just for Apple, but for everybody. So, I think it's interesting, but I think it's more of a long-term play. One of the problems I think we're seeing in general with the market, hearing you guys chat, is people are expecting that all this AI stuff is like, bam, immediately going to impact everything. It's like, guys, that's not the way this works. And it's going to take a while. So, the question is, do people have patience in the market? They typically don't. So, we are where we are.
Bob, another big event that's taking place in the tech world today, or starting, I should say, is Google's antitrust trial. And of course, the focus of this trial is on Google's advertising business. I'm curious, just from your perspective, talk to us about what's at stake and the significance of this trial, maybe some of the implications here for not only Google, but some of the other larger tech giants.
Sure, Shauna. No, I mean, this is an interesting one. It's a really kind of a complex story because it's not about Google's ad business. It's about their ad selling business. So behind the scenes, and this is something we don't typically interact with, there's a big marketplace for buying and selling ads on websites and what have you. And Google has had the tools to do that, and the government is arguing a monopoly in that particular area. Now, it's hard to figure it all out and all the pieces because it's not even all the ad business. It's not the ad words. It's the other portion. And even if worse comes to worse, something happens and oh, by the way, this is all going to take years and years and years because that's how DOJ stuff is. Even if something happens and they have to sell off that little piece, nothing that you or I interact with Google would change, right? This would be the businesses that interact with and buy ads via Google that would change. Obviously, that's important to Alphabet as a conglomerate, and there's certainly a question of what that impact would be. Most of the suggestions I've seen have been, pretty small.
All right, Bob O'Donnell, always great to get your insight. Thanks so much for hopping on and joining us here this morning, a Technalysis Research President. Thanks so much, Bob. Investors are gearing up for a busy week of econ data with two final inflation readings out before the Fed meeting next week. The U.S. Bureau of Labor Statistics will release both consumer and producer price index numbers for August. Will this data help affect Friday's jobs report after it raised more questions than it answered? I think the big question is, what exactly does this data, what is it going to mean here for the Fed's decision next week? We want to bring Yahoo Finance's markets reporter, Josh Schaefer. And Josh, talk to us about this because I believe the consensus had been, at least, that the Fed's fight to tame inflation, maybe it was in the rearview mirror. So how much is riding on this report?
Yeah, I mean, I think you can see the Fed getting more confidence, right? That's what economists are sort of reasoning here. But if we get a better than expected or in line CPI print on Wednesday, it will be the fifth straight report that has shown, I guess, positive trend toward the Fed's 2% goal, right? Fifth straight. That's a pretty good streak at this point. This is similar to maybe the streak we were on at the end of last year, where that trend feels like it's relatively in place. So a lot of economists reasoning that maybe a benign CPI report, one that it doesn't stroke any fears, could help the argument for 50, but does it really push the Fed toward 50? Most people think you would need more soft labor market data to get that. And between now and the Federal Reserve meeting, we're not going to really get any more labor market data unless
weekly jobless claims
catch on fire suddenly in a random week. Like, that's very unlikely to happen. So you're not going to really kind of get that data. So it seems like really you're just looking for something to confirm trend a little bit more, make the Fed a little bit more confident, and then maybe at most it leads Powell to talk even more about the labor market than he did the last time we heard from him in terms of what he talks about in the press conference and what's going to be driving cuts moving forward.
How aggressively, though, do you think they could implement cuts, knowing that they're now just going to be laser focused on one part of their dual mandate, it seems, as inflation is coming closer to their target?
I mean, Brad, post-Friday, right, and really digging into some of the commentary, it feels like we're one more bad labor report away from everyone feeling like the Fed's going 50 the next time we hear from them. Because it felt like that report didn't really sway things either way. Yes, there were signs of strength in it, but you look at the revisions, 88,000 less jobs for the last 2 months than we initially thought. The unemployment rate coming down on essentially a rounding little detail. So there wasn't a ton of strength in that report. It feels like if we get one more bad report, then maybe we do get the 50, because really the market's still pricing in 4 cuts this year. Has to come at some point if we're going to get there. If the Fed's really off sides, they need to move 50 at some point.
Josh, quick question for you here, because this is the big debate, right? How far are they going to go? Are they going to do 25? Are they going to start with a larger cut and do 50? What is better for the markets? Because when you take a look at the historical
25,
data, right? 25 obviously is. But we've actually got a guest coming up later on the show is going to say that we'll see a sell-off if the Fed only cuts by 25. So explain, I guess, what the rationale is on Wall Street, because you would think that the market would very much be rooting for 25, given what that would tell us about the economy.
So people that want 50 and think that 50 is good for the market are not thinking about next week. They're thinking about probably the next 5 to 6 months, right? Mm-hmm. And so the concept there would be, well, the Fed is significantly offsides, meaning the Fed is too restrictive and the sort of long and variable lags that we've talked about a lot are coming soon. So if they don't fix that very quickly, then the deterioration in the labor market could be worse. Now, there is the other school of thought, which we were both just alluding to there. If they go 50, maybe they're admitting that that slowing in the labor market has already started, and there's an issue there. I don't think the jobs report told you that. If they cut 50 off that jobs report, I don't think they're saying, hey, there's a big issue here. They might just be saying policy's too tight. But it seems like the read going into next week, at least for now, is 50 feels a little panicky. I'm a little bit more comfortable with 25. But there's a week for us to argue about the data, so we'll see where we land by that point.
It certainly is, and there's a week for traders to change their minds in terms of what they think the Fed should do. All right, Josh, great stuff. Thanks so much. Well, this week, Yahoo Finance is bringing you the latest from the 2024 Goldman Sachs Communacopia and Technology Conference. Yahoo Finance's executive editor, Brian Sozzi, and Catalyst host Madison Mills, they both will be sitting down with a stellar lineup of top executives about how advancements are transforming today's industries. Coverage kicks off this afternoon. You're going to want to tune in to Market Domination Overtime today. We will be hearing a conversation with AMD CEO Lisa Su. And stick around after that. In Asking for a Trend, we're going to see a sit-down interview between Madison Mills and AWS CEO Matt Garman. And tune into Catalyst and Wealth this week for interviews with executives from Robinhood, Okta, and Affirm.
Coming up, everyone, we take a look at today's trending tickers and why Nvidia is seeing a pop here in the pre-market. And a programming note, be sure to check out Yahoo Finance's Opening Bid podcast, bringing you the biggest names on Wall Street and the hottest takes on the stocks powering your portfolio. We've got that every Monday, Wednesday, and Friday. MWF, 8:30 a.m. Now time for today's trending tickers that we're tracking here throughout the trading day. You can also track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. Scan the QR code here on your screen below to check out the latest. All right, let's get to it. Nvidia, those shares are rising here in pre-market after seeing a 12% decline last week. And it certainly was a pullback, but ultimately it's more in line with what we had seen in the broader market route as well. So not even just insulated to technology. And we were sitting here on set and looking at how the sell-off was intensifying and saying, if this pours over from technology into other sectors, including consumer staples, that's where you could see even more of that jitteriness and the volatility spike here. But while we're talking about Nvidia, it's also important to remember that a lot of the thesis hadn't really changed outside of just what the guidance looks like. Guidance is going to become more challenged as they go up against some tough growth comps. And so that's something to remember. But at the same time here, and I'll end with this. At the company level, Nvidia was the largest contributor to revenue growth for the information technology sector during this quarter. If the company were excluded, the blended revenue growth rate year over year for IT would fall to 7% from 11%. Similarly so, largest contributor to earnings growth for the sector. Without Nvidia, the information technology sector would have seen earnings growth of 9.9%. What was it actually? Oh yeah, 20.3%.
Yeah, and I think the big questions here going forward, a lot of this on the heels of the most recent earnings report and the reaction that we saw thereafter. So I think there's lots of questions about how much of this optimism and excitement has already been priced into the stock, given the massive move that we've seen year to date over the past 1 and 2 years. So again, lots of questions there. And then what I found interesting was some of the commentary coming out of Wall Street here over the last several days since we did get that most recent earnings print. And the note that caught my eye was the team over at Citi, Scott Kroner at the team. He leads the U.S. equities team, and he was talking about the fact that they actually don't expect Nvidia to carry on being a massive driver of returns for the S&P going forward. And they're making the argument that their sense is that Nvidia is becoming just another large cap growth stock. So I think that then begs the question, going back to what you were just saying, if we do see a significant slowdown in earnings growth here over the next several quarters and looking out beyond that, just what exactly that means for the broader market. And then, of course, we haven't even talked about the fact, the expectation of rate cuts. And we saw that just being priced in, I think, a little bit to this tech sector last week. So as we move forward and get closer to the Fed's first decision or potentially first rate cut here this cycle for first cut here for rates this cycle, I think there's lots of questions about whether or not we're going to see a rotation or an underperformance here of technology as more investors see maybe some opportunity in those names that haven't necessarily participated yet. All right, we also want to take a look at Palantir and Dell, the two companies joining the S&P 500 today. Shares are to no surprise reacting positively to this news. You got Palantir up just about 8%. You've got Dell up just about 5%. And Brad, before the show, I was going through some of the commentary here from the street. Dan Ives calling the addition a, quote, validation moment for the stock, not necessarily a big surprise there. We know that the company has guided for about 47% of U.S. commercial revenue gains this year. They're looking to diversify beyond government customers. And then when you take a look at Dell's business, there was actually a note out from Citi saying that there's a number of catalysts here for this stock beyond this S&P inclusion. So they think, at least, that there is still some momentum here to the upside and room for Dell to run. Yeah,
Evercore ISI saying it's incrementally positive as it would drive more focus on the name for Dell here particularly. It also comes into focus here for Palantir for me as of looking through some of the company's earnings and what we had seen most recently even in the post-earnings report, deal making that this company has been able to do. Strategic partnerships with Microsoft. You've also got a recent BP deal that they just announced this morning. And so the AIP, that AI platform, really becoming even more so entrenched and getting some more major deals post-earnings here that could factor into that guidance that the company had essentially set forth here. PLRT shares certainly, or PLTR, excuse me, shares certainly off to the races, up by about 98% over the course of the past 52 weeks. Finally, let's take a look at shares of Merck taking a hit as rival Summit Therapeutics presented their latest data from their lung cancer drug that beat Merck's Keytruda. Merck shares, MRK, they are down pre-market by about 3% here right now. I mean, here's why it's so important. Well, Merck has this Keytruda drug that you may have heard of before, and it is one of the best performing for the business. And I mean, if you're asking how well of the performance it is. I mean, it drives the majority of the revenues, just shy of about 50% of the revenues. I think it was about $7 billion out of the $16 billion in revenue that they brought in the most recent quarter here. One of the other things that they also need to demonstrate at Merck, and they talked about this in the most recent earnings and on the call, is that they really just need to develop even more so into this pipeline for their portfolio as well, trying to diversify it, getting multiple categories, and just getting more regulatory approvals for different use cases of Keytruda as well at the same time, which already has something like 40 approvals for different oncology use cases as well.
Yeah, when you look at the move in the pre-market, you can clearly see, I guess, some of the worry here from the street just in terms of what this would mean for competition for Keytruda down the line. But on the flip side there, maybe taking the contrarian point of view, there were some analysts out this morning saying that if we do see a dip like the one we are seeing right now, it actually might be a bit of an overreaction. And the reasoning there is that they were saying that they actually see little threat to Keytruda in the near term. So the near term is that the key wording there, just saying that they do still see, obviously, Merck being that leader, at least in the near term. And like you were saying, it is so critical here to Merck's business to talk about the fact that its outsized impact that it does have on sales, on revenue, that the company generates $7.3 billion in sales in the second quarter alone. That was up 16% from just a year ago. So you talk about some of the momentum that we have seen within this name, and that's why we are seeing such a reaction from the street here. Not so much about what this ultimately means over the next couple of quarters, but maybe more so what it means a couple of years out.
Absolutely. All right, we're going to be continuing to track all those tickers going into the opening trade here, the opening cross. We're just minutes away from that and the opening bell. We're going to take a look at where to find safety in the market in today's strategy session. We've got Brad McMillan from Commonwealth Financial Network. He's going to be joining us. You're watching The Morning Brief. All right, we're just seconds away from the opening bell. You're taking a look at U.S. futures to begin this new trading week here. Of course, it's a big CPI energy week, but before then, you get a look at the Dow, the S&P 500, and the Nasdaq futures here on this Monday. As of right now, you're seeing things move to the upside by about 0.8% for the Dow, the S&P 500, and the Nasdaq up 0.9%. Here is the opening bell. And in today's game of Who Rang That Bell, move over Key and Peele's East-West Bowl. You got East-West Bank ringing the opening bell at the Nasdaq, and at the NYSE, you've got Medtronic. Looks like they're celebrating 75 years, ticker symbol MDT. Congratulations to the team over there. All right, let's take a look at the markets and where we begin today's trading activity. I'm going to give you a little bit of context here. Coming out of last week's move, past 5 days, we've been down more than 3% on the S&P 500, but there you're taking a look at today's little bitty bump or bounce, if you want to call it that. It's up right now by about 0.7%. Continue to keep a close eye on that as we move forward throughout the rest of the week. Oh yeah, it was a big decline last week as well for the Nasdaq, down about 5% here. As you're taking a look over today's gains right now, it's only about 0.9% here. And then additionally, taking a look at the Dow Jones Industrial Average, right now that begins the day higher by about 0.7%. We'll round that off too. As we're taking a look at the Nasdaq, I'll give you a look at that heat map just so you can take a snapshot of how we've been moving to kick off today's trading activity. Some of the mega cap tech moves that you're seeing. Nvidia trying to route a comeback here as well. Still got a little bit more work to do. Let's put some lines on this chart for you there. Over the past 5 days, down by about 11%. Apple, they got a big day coming up, especially with the expected announcements of the new Apple iPhones. You're going to be looking for new watches. Our own Dan Halley is going to have continuing coverage all across that. As of right now, flat, just barely to the upside. We'll see what the tick by tick looks like going into that event. And then let's also take a look at some sectors here as we're looking at today's trading session. Early moments have technology being the big bounce back story. As of right now, it's up by about 1.4%. But again, context key here. Past 5 days, down by about 6%. Led those declines that we had seen during the sell-off last week. And then lastly here, we'll take a look at the Dow components. 30 of them, we got them lined up here for you on the day. And as of right now, just a few spots of red. We mentioned Merck, we talked about that, and the challenge to Keytruda, but still, a lot of analysts' coverage seems like it's still leaning bullish towards some of the entrenchment. We'll see if that gets shaken up with the latest development instead of come about from that. But mostly green across the screen. Microsoft up by about 1.4%. Shauna, I'll toss it on over to you.
That's certainly love to see it, especially after last week's sell-off. All right, well, it's time now for today's strategy session. Our next guest seeing some volatility continuing to ramp up in the coming months. Even SEC's no signs, at least for now, of a recession ahead. Joining us, we want to bring in Brad McMillan. He's Commonwealth Financial Network's Chief Investment Officer. Brad, it's great to see you. So here we are today looking at green on the screen, coming off what was a very, very tumultuous week here for the markets. When you take a look at that roller coaster ride, is it just getting started, and why?
Good morning, Shauna. I think we're going to have some volatility here going forward. I expect to see more bounces ahead. But I think the important thing here is that volatility is going to be constrained, because you got two things going on here. First of all, the economy is basically doing okay. It's slowing down, but I don't see a recession in the immediate future. And second of all, even though the market is going back and forth on how big the rate cuts are, the fact of the matter is we're going to see one. So I think both of those things, it's the market trying to come to grips with that. So volatility, but we're still okay.
Okay, and so even amid volatility, there seems like for many people who are looking for the buying opportunities out there, more of this mentality for buying on the dips. Where are those dip buying sectors, opportunities that you're looking across and keeping on your notepad?
I think the thing to keep in mind here is the market is still looking to adjust to a more defensive posture. We're still going to have growth, but it's going to be slower. And we're going to see shifting from the Fed raising or holding to cutting. So I think because of that, you want to be looking at staples. That's defensive, but it still offers the opportunity for growth, and it offers interest rate sensitivity. You want to look at real estate. Real estate has gotten hit hard, and for very good reasons. But with rates coming back down, that starts to make a little bit more sense. And then safety and yield, you look at utilities. I think you're defensive today, but I think the reason that works is because it plays into the interest rates rather than a recession.
What does that then tell us about technology? We talk about the fact that we're expecting this rotation just in terms of leadership. I guess underperformance relative to the rest of the market. What are you expecting to see there? And how should then investors further diversify, or what do you still find, if anything, attractive within tech?
Well, tech has been a big play on growth. It's been an AI story. I mean, a lot of what has been driving this is the idea that the AI tree is going to grow to the sky. And we're starting to get some realization. You're starting to see some numbers out there that say, no, that's not going to happen. So a lot of this is investment driven, all of these companies. So I think there is some downside risk there. But at the same time, these are very solid businesses. So I think it is relative underperformance rather than a collapse. And I think as we move into this kind of environment, I think dividends are going to become more important, which also points more to a value rotation.
Which companies are perhaps the most vulnerable to a pullback and further pullback on the realization that this AI tree does not grow to the sky, if you will?
Well, when you look at valuations and you look at recent performance, I think Nvidia is certainly one that comes to mind. Fantastic company, wonderful technology. Is everybody going to need to buy 50% more of their product every year for the next 10? I'm not so sure. And because of that, when you look at the fact that the price is to perfection, you can be cautious about the stock with it while still acknowledging it's a terrific company.
What type of pullback then are you expecting in Nvidia over that longer term, perhaps, because of the valuation call?
I haven't actually done the numbers, to be honest with you, so I can't give you a target. But I think if we saw valuations and growth rates normalize, that would necessarily imply we're going to see at least slower growth and quite possibly a pullback.
Rob, when it comes to the Fed's next decision here, a highly anticipated decision next week, a lot of focus is going to be on those inflation prints that we're going to be getting out over the next couple of days. From your assessment, how much of the focus should still be on inflation versus some of the weakness, softness that we're seeing within the labor market? And is the Fed's fight to tame inflation, is that over in your view?
I don't think the Fed's fight for inflation is over. And I think the Fed has been very clear to say that they are no longer solely focused on inflation because they are worried about the labor market. But I don't think they've given up on it at all. And I think there are two things going on here. First of all, when you look at the headline numbers, inflation improvement is pretty much stalled. But then you go to core and it's coming down, and you look at the more recent data annualized, and it's actually dropping back down. And that's what Powell was talking about. So we have some potential here that inflation is under control. Whether that's true or not, well, we'll find out. And we're seeing a deterioration in the labor market. But again, when you look at the year-on-year numbers, even when you look at the monthly numbers, they're not that terrible, except by recent incredibly strong standards. So the Fed is starting to pay a little bit of attention to employment, but they haven't given up on inflation. And I see a quarter point and then a pause unless something happens with the data.
You know, it's really interesting. Is it an all-out deterioration in the labor market or employment situation, or is it normalization? How should we be thinking about this? I was looking at some data from BlackRock, and one of their takes was, well, if you have this much more immigration that's also inserted into the system, then that's, of course, going to give you a larger base of people that's going to impact the unemployment rate as well. So how should we be thinking about this?
I see it as normalization. I see that from a couple of different angles. First of all, if you look at the year-on-year employment growth, we're still seeing fairly strong growth. We're still seeing fairly strong numbers from the establishment survey. The household survey has weakened a bit, but historically, it's still quite strong. So, this notion that the whole thing is falling apart just doesn't seem to be there. You look at the JOLTS numbers, the quits numbers, same thing, weaker, but basically back to 2015, 2016 normal. Not as strong as it was 2017, 2018, but a heck of a lot stronger and still very healthy. So when I look at that, I see us going back to something like normal. And I see inflation or immigration, actually helping to bring the labor force up to where it should be. That's a good thing because that'll help get inflation under control as well.
Brad McMillan of Commonwealth Financial Network. Brad, thanks for the time just after the opening bell this morning. Appreciate it.
Thank you, Brad.
Certainly. All your markets action ahead. Stay tuned. You're watching the Morning Brief. Boeing shares are seeing a nice little boost this morning after the embattled airplane manufacturer reached a tentative agreement with its largest union to avert a strike here. For more on this, let's bring in Ron, my gosh, what is it, Monday? Ron Epstein, who is the Bank of America aerospace research analyst. He has a hold rating on Boeing and a $200 price target. Boeing themselves, Ron, have a fresh new deal. It's slated to be voted on as well here, we should note, so not totally ratified, but are you anticipating that it will go through? Does it look like the union has what they were pushing for?
Yeah, I mean, on one hand it does. On the other hand, it doesn't. So it's, to be honest, it's hard to say. After the union leadership said, "Hey, you know what? This is okay," the social media feeds with the union kind of blew up. Now you don't know what to read there because sometimes the most vocal people are the ones that are on social media. They got a lot of what they wanted. I know one of the key things that the union leadership wanted was a view on future work, right? So a key piece here is if in the next 4 years Boeing launches a new airplane, a lot of the work, I mean, a lion's share of the work will end up in the Puget Sound, and that's what they were looking for. And I think that's one of the key reasons why the union leadership said, "Hey, this is a good deal." But the balance here is, if you look at what happened in terms of broader comp, Boeing's outgoing CEO had a huge raise. I think his was 43% or something like that, or 34%, excuse me, up year on year, and that's not lost on the union. That their pay increase over the length of this contract would be 25% increase. So we'll see how it goes. I'm hopeful that the union ratifies it, but I would say at this point it's not a slam dunk, but it's definitely a move in the right direction.
Ron, when you take a look at the stock's reaction, obviously there's lots of optimism going off of what you just said. How big of a win would this be? Is this potentially for Boeing? And do you see further upside in the stock if it in fact is approved later this week?
Yeah, well, I mean, we clearly do see further upside. I mean, our price target's above where the shares are trading today. Now, this is, the issue with the strike, and I think this is key. One, I think broadly consensus was they're going to have a strike, right? So if they don't have a strike, that's clearly a positive surprise, right? So hence you're seeing the reaction in the stock. Two, as you all know, there's so much going on at Boeing right now in terms of challenges, both in the defense business, the space business, the commercial airplane business. Really, the last thing that the company needed now is a labor challenge, is the union to go on strike. Strikes like this, particularly in the commercial side, can be very hard to recover from, but they haven't even recovered from COVID and the 737 shutdowns and the 787 shutdowns. So it just sort of makes kind of all those bad things even worse. So if they can get this behind them, and this is just one less thing that they have to worry about, that's a big win. And then the second thing I would say, you have a new CEO who's been in the role for a couple of weeks, and if they can get through this without a strike, this would definitely be seen as I think a huge win for Kelly Ortberg, like I said, who just hasn't been there that long, kind of setting up a new footing with labor.
Ron, labor is included as the cost of sales for Boeing. So ultimately, how do you see the cost of sales as a percentage of revenue kind of either remaining consistent or having a material difference as a result of this deal, and for how investors should think about that?
Yeah, so when we were playing with the numbers on their, the union had said that they wanted at least a 40% pay increase over a period of 3 to 4 years. With this contract offer, they got a 25% increase. With a 40% increase, we were modeling it was probably about $1 billion of extra cost. So in this case, right, it'd be about 15% less. So you're talking maybe call it 800 million of extra cost, 850 million of extra cost for Boeing.
So Ron, this would be a big step in the right direction here for Kelly Ortberg. Like you just said, looking ahead then, beyond what's happening here today, what is the next big challenge that Kelly needs to worry about? What should be that top priority?
Yeah, well, it's a number of things. So, one thing that he has already said that he's done himself, he's moving to Seattle, right? He's moving to Puget Sound. I wouldn't be surprised if you see the headquarters of the Boeing company move back to the Puget Sound. I mean, it makes sense to be co-located with your largest manufacturing location, one. And then changing the culture of the company. And there's been a lot talked about this, written about this. But why are you seeing all these deficiencies in terms of engineering, manufacturing, so on and so forth? It has to do with culture. So that's a top-down thing. So I would imagine the next thing he'll do is start, changing the chess pieces on the board, bringing in some of his trusted colleagues and then people he's worked with over the years to start really pushing, culture, from the top down. Just to remind everybody, Kelly was a longtime executive at Rockwell Collins. Rockwell Collins was a company that was very well respected by their customers, loved by their employees, and so on and so forth. Collins, I think you could hold up, on a pedestal as having a very good culture. So trying to rebuild that kind of culture at Boeing, and then that will bring forth the improvements in the commercial production, what we need to see in the defense business, potentially the space business, maybe playing with the portfolio. There's been some written about maybe Boeing selling off some non-core assets to raise some money to help shore up the balance sheet, that kind of stuff.
All right, I'm already going to set up my tour of that Seattle, Tacoma, and the Seattle Puget Sound operation. I couldn't do it last time I was in Seattle. They still had some COVID rules in effect.
I recommend it. It's a great tour.
Yeah? Okay. All right. I'm going to put it down on my calendar. Just lastly, while we have you here, Ron, I mean, you talked about the culture. You talked about this leadership change. What type of timing are you grading Boeing on to see a real difference in how the operations now post Spirit Aerosystems acquisition, now post new CEO, and now post what is going to be a major ratification of a new labor deal? What is that time frame, the kind of window of cushion that you give them to really turn this around?
It's going to take time. It's a very large company. It's a very complex company that makes very complex products. One of my fears is investors tend to want everything now, next week, next quarter. This could take a number of years. I mean, I wouldn't be surprised to get a full turnaround of something like this. Could take 5 to 7 years. Now, it's not going to take that long for this to get priced into the stock, but sometimes investors do get ahead of themselves. And my advice to investors would be, you just have to be patient. If you look at GE as a case in point where you saw a turnaround, it took a while and then it really worked. Boeing has this much potential of a turnaround like GE did, but it's going to take some time. And in some ways, the Boeing turnaround is very, very complicated because some of the issues at Boeing are more complex and more deeply rooted.
Does that mean we shouldn't expect any new aircraft innovation in the near term then?
I think they're going to have to do it. I've said for a long time that Boeing should do a new airplane, needs to do an airplane for a number of reasons. One, they're losing market share to Airbus in kind of this middle of the market, large narrow body, small wide body market. And then two, if you don't exercise that engineering muscle, you lose it, meaning you just lose people. And we're in a market today where there's no shortage of really interesting things and interesting companies for engineers to go do. I mean, you can go work on electric aviation, hydrogen aviation. The big defense contractors have all kinds of interesting stuff going on because where defense budgets are. So there's a talent, there's a war for that kind of talent. And if that talent isn't being challenged or doing fun things at Boeing, they'll do it someplace else. So if one of the key reasons to do it is to kind of keep that engineering workforce around. But we've done estimates, and we think the market for a new airplane could be upwards of $70-80 billion. I mean, it's a big market.
All right, Ron Epstein, always great to get your insight and talk to you here, especially on a day like today. Bank of America's aerospace research analyst. Thanks so much, Ron.
Thanks.
Coming up, set your timers. We're going to recap some of today's biggest movers in 30 seconds each. We're just about 21 minutes into the trading day. When you take a look at the major average, we are still looking at gains across the board. You've got the Nasdaq leading the way after tech was hit very hard last week. So we're seeing a bit of a rebound here this morning. You've also got the S&P up nearly 1%. We'll be right back.
We're taking a closer look at some big moves in Yahoo Finance's trending tickers, and we're doing it in 30 seconds each. Let's go. First up, Big Lots. Those shares are up right now by about 9% after the company announced it is officially filed for Chapter 11 bankruptcy. In the announcement, Big Lots called out macro headwinds like high inflation and interest rates that took a toll on its business in recent quarters. The discount retailer also announced that it has entered into a sale agreement with investor Nexus Capital Management. Big Lots saying its second quarter results, which are scheduled for September 12th, will be in line with the previous guidance here. They're also trying to optimize their go-forward store footprint as part of the court-supervised sale process, continuing to assess that operational footprint.
All right, let's take a look at GameStop, the next stock that we are watching here today. The meme stock favorite releasing its second quarter results after the bell tomorrow. Analysts at Wedbush, well, they're a bit skeptical about the company's path forward, to no surprise. And they noted that shares of the video game retailer, well, they're trading at levels that, quote, ignore the company's many challenges ahead. I think a lot of people would agree with that sentiment. Their price target of $11 a share is less than half of GameStop's current trading price. You're looking at the current trading price of just about $23 a share. Well, trader Keith Gill, whose Roaring Kitty social media posts are reignited volatility in the stock back in May. He posted to X again on Friday. Well, that added some volatility to some of these names. The meme adjacent names like Chewy and AMC also moving alongside GameStop on that post. So again, when you take into account that this stock does not trade along with fundamentals, there's many reasons to think that there are some weakness within their underlying business. You talk about the fact the shift from physical to digital game store sales, that's obviously impacting the business. Just a slowdown that we are seeing on consumer spending. Reason to be a bit skeptical maybe about what these results were. And we're also likely not going to get an earnings call after this report. There's been no mention, and there hasn't been an earnings call following these reports going back to 2023. So likely no change there.
All right, and lastly, let's take a look at shares of Trump Media. The ticker symbol there is DJT. That is higher right now by about 11%, likely ahead of tomorrow night's debate between the former president and Vice President Kamala Harris. Since the company first went public via merger back in March, Trump had been unable to sell any of his shares as part of a standard lockup agreement, and it's cost him big time. Over the past 6 months, shares of Trump Media have declined nearly 60% here, more than 50% at this juncture with today's move factored in. But doesn't negate the fact that it's erased billions of dollars from Trump's stake here. And a reminder that you can track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page here. So we'll continue to keep an eye on all of those. And of course, we've got that QR code for you in the corner.
We certainly do. We'll keep right here on Yahoo Finance. Brad and I, we are just getting started. We've got a whole another hour for you. Taking a look at what's ahead, you've got stocks rebounding from a no good, very bad week with three big events on deck. You got Apple's event, the presidential debate, and CPI all this week, and stocks continue that slight rally that we're seeing today. We're going to dive into this and more next on Catalyst. Welcome to Catalyst. I'm Shauna Smith alongside Brad Smith. We're just about 30 minutes into the trading day. We're watching three catalysts impacting markets. You've got traders pricing in rate cuts ahead of the inflation data, Apple's big event, and the upcoming presidential debate.
Well, upcoming inflation readings will be key for the Fed ahead of the central bank's rate decision next week. The market currently pricing in a 75% chance of a 25 basis point cut. And that's after Friday's mixed jobs report. So will the CPI, that consumer price index, change the Fed's thinking? We will see.
And Apple's event could be the next big catalyst for the AI trade. The tech giant is expected to tout new AI features for its upcoming iPhones. With tech dragging the broader markets lower last week, will the big tech giant's announcement be enough to reignite the AI rally?
And plus, American voters, they are getting set to see Vice President Harris and former President Trump go head-to-head for the first time in tomorrow's presidential debate Tuesday. With the two candidates neck and neck in recent polling, what policies do they need to really hammer home for investors who are watching?
All right, well, we are just about 32 minutes into the trading day. Let's take a look at where things stand. You've got stocks attempting to bounce back. Well, they are bouncing back after last week's deep rout. You've got all three of the major averages pointing to gains here shortly after the open. You've got the Nasdaq leading the way, up just about 1.2%. Weak economic data ending with a mixed jobs report. Well, that sent markets tumbling last week. You had the S&P logging its worst week since early 2023. Well, CPI is the next big test for the market. Is recent data showing enough moderation in prices and economic growth to signal a soft landing? And ultimately, what does all this mean for the Fed's decision? Let's bring in Matt Maley. He is the managing director and equity strategist at Miller Tabak. Matt, it's great to have you here. So talk to me about what's already been priced in and maybe what the market is anticipating. It certainly looks like investors are betting on the fact that we're going to see a 25 basis point cut next week. What does that then signal for equities?
Well, I mean, that is, I guess, somewhat helpful. I mean, the one concern is that, if they do feel that they have to go 50 basis point, I actually think that will scare some people because the market is not pricing in any kind of a hard landing. In fact, I would argue that they're not even pricing in, the market's not even pricing in a soft landing. It's pricing in a very strong economy going forward. So I'm a little bit worried that we're not going to get that over the next 6, 12, 18 months to kind of justify these moves in the stock market. But, the fact that the earnings are growing, the fact that the economy is still growing should be able to help hold up things for a little bit of while. But at some point, when you get the market as expensive it is today, they have to kind of face the reality that 22 times earnings is really going to be tough to justify over a longer period of time.
And so, Matt, with that in mind, I mean, for the Fed, as they're trying to validate 25 basis points, if that was the decision that they made, if CPI came in, just as expected or even better than expected, how much does that continue to allow the Fed to just say, hey, we're going to go slow and steady with the amount of cuts that we're anticipating putting into the system?
Yeah, I definitely think that that's what they'll do. I mean, we get something that, unless it's really, really weak, and again, that might raise questions about what's going on with the economy. I mean, we see oil prices going down, we see China growth really slowing down. What kind of impact will that have? But I think they'd really like to go steady to get started, slow and steady to get started. And if they need to pick up and get more aggressive as we move through the rest of this year or into next year, they can always do that. But I just don't see the real need to make that move just yet.
Matt, what does that then tell us about what we will see leadership-wise? When you talk about the fact that tech, for a number of reasons, and you can blame some of it on Nvidia, you can blame some of it for maybe starting to price in the fact that we could get rate cuts. Do you expect to see further pressure on tech, and how should investors then be positioned?
Well, one of the things we're going to see, of course, is what happens here with Apple. I mean, I guess the biggest narrative in the last 6-8 weeks has been that the earnings from the AI phenomenon are not going to broaden out to the degree people were hoping for this time last year or even 6 months ago. We're still seeing great numbers out of Nvidia and some of these other companies, but the end users are not getting the return on their investment as quickly as people had thought. So if again, Apple doesn't necessarily have to fall flat on its face to be a problem, but they do need to show some signs that it's going to be something that's going to be positive, because most of the rest of these end users are really not seeing the return on investment we'd like to, that would justify these big moves in the marketplace. I mean, Microsoft's spending $10 billion a month on this phenomenon. So we're going to need to see something out of Apple to really help things to turn around a little bit.
And so in that case, is tech earnings growth more key to the broadening out than tech profit taking, and then some of that capital or some of that money going into other areas and other sectors for investment?
Well, the biggest concern I have about this issue, the rotation issue. I mean, the one thing is that we saw in the second half of August, or really the last 3 weeks of August, where the tech group, even though it was lagging, it only retraced about 2/3 of its decline, of its summer decline, while the S&P recovered all of its decline. So it was lagging a little bit, but that's okay. It was still rising. So people felt the confidence to be able to rotate some of their money out of tech and into other areas. But when the group started to roll over, it's too heavily invested, way too heavily, weighted in the S&P and the Russell the Nasdaq, the NDX 100. So as those indexes started to roll over, that made people much more nervous. And so I guess my point is that you need to have the tech group either rising, even if it's lagging, but if it's or for you to see any kind of rotation. If it goes down and the major indices go down, people tend to pull their money out and rotate into cash. So we got to be. So this tech group is going to still be very, very important over the next couple of weeks and really for the rest of the year.
Matt, I'm curious to get your thoughts on the action that we've seen recently in the bond market, and whether or not maybe the initial reaction to the jobs report that we got Friday is that something that's now being recalculated, and what do you think about what is already being priced in terms of rate cuts, and maybe whether or not there needs to be or will likely be a further reevaluation?
Well, we could see. I mean, the bond market is being, the bond yields are getting oversold, which means bond prices are getting overbought. But that's on a short-term basis. So we could see a little bit of a bounce back in price a pullback in price and a move up in yields. But first of all, on a technical level, we've definitely seen this. We broke below that 3.8% key support level on the 10-year note. We've seen the 2-year note break down in a significant way, well below any kind of trend line, and it's made a lower high and a lower low. That's that's on the yield side. That's going down, but that means prices are going up. And I think that key change in trend for the bond market means that bond investors are going to do very well over the rest of this year. Again, on a near-term basis, I wouldn't be chasing the bond market. We could see a little bit of a pullback here, again, with a bounce in rates, but I don't think that will last very long, because it just seems like to me like the situation, whether it be the geopolitical situation, which is still very rough, and the flight to safety move can play an impact in there. But there's no question that our economy, even if we're not going to hit a recession, it is slowing down. That bodes well for the bond market.
Matt Maley, who is the Miller Tabak Managing Director and Equity Strategist. Matt, always a pleasure to grab some time with you. Thanks so much.
Thank you.
Certainly. Well, Apple's big iPhone event kicks off this afternoon. There's a lot riding on this after a tough week for tech that saw the sector down over 6% and the Nasdaq off 4%. So how does Apple have to deliver today? That's the big question. And joining us now from Cupertino, California, awaiting the start of the big event, our very own Dan Halley. Dan, what's the vibe? Pulse check out there? How are people feeling? I guess it's only 7 a.m., so they're still getting coffee.
Yeah, people still getting coffee around here. They're still setting up to prepare for the event, as you can see behind me. But really what I think most people are expecting here are kind of the usual, with the exception of the Apple AI. So the usual, let's just level set that. 4 new iPhones. It's going to be the iPhone 16, iPhone 16 Plus, Pro, and then Pro Max. We're also expecting new Apple Watches, the SE, the Series 10, the 10th anniversary edition of the Apple Watch. It's been 10 years since Apple originally announced it. And so this would be a big year for them. And then the Watch Ultra. Really the big difference is going to be for that middle one, the Series 10. I expect to be 2 new sizes, 45 millimeter up from 41 and a 49 millimeter up from 45. But reports say that they're not necessarily going to be larger as far as footprint goes. It's going to be a thinner body design. So don't expect to take up too much screen real estate. It's not going to be one of those big statement watches that you might see folks have. And then the last thing that we're expecting as far as hardware goes is updates to the AirPods. So those will be for the entry level, the base AirPods, and then the mid-tier AirPods. Those are supposedly getting active noise cancellation, which would be a good fit for something that costs $169. The highest end, the AirPods Pro, though, would still have those silicone tips, the bad boys that I'm wearing right now. And then they're also going to have new AirPods Max. Those are the ones that are over the ear, the cans kind of. Those are expected to get some updates with some better sounds. But obviously, we want to talk about Apple Intelligence and the big changes there. That's going to be the kind of series of AI rollouts that Apple's going to have. You know, there have been on Wall Street some rumblings about how Apple hadn't kept up with the likes of Microsoft and Google. Now they're expected to start rolling some of those out, although reports indicate that they might not necessarily come out with the new phones. It might take them until October and into 2025 to get most of the AI features they announced in June into phones.
All right, Hallie, good luck out there. We, of course, are going to be tracking every word from that announcement. We look forward to your live coverage on Yahoo Finance later today. Well, let's take a look at the markets just about 42 minutes into the trading day. And this market check sponsored by Tasty Trade. We're seeing a bit of a bounce back across the board, at least for the major averages. You're looking at gains. The S&P coming off its worst week since 2023. And today you're looking at a gain of just over 1%. You've got the Nasdaq leading the way. That has been the case since the open, since the start of today's trading session. You now have the Dow right around the highs of the session, up just about 400 points. So again, some buying action following the weakness that we saw in the markets last week. When you take a look at the sector action, all 11 of the S&P sectors moving to the upside. And quickly, if we could throw up the bond market right now and take a look at treasuries, we are seeing this slightly move higher here for yield. So again, good to or important here to track. You got the 10-year yield of right around 3.72.
I'm going to go to the blockchain for a hot second here. Let's check in on Bitcoin to see what BTC USD is doing. Of course, just the largest cryptocurrency here. Bitcoin right now, you're seeing it up by about 2.7%. Still below 60,000. That was a key psychological threshold. We saw it cross below that. We'll see if we can get back above it this week. It depends upon what that risk-on appetite looks like. But as of right now, you're seeing some positive gains over the past 24-hour period because the cryptocurrency markets don't close. That's the move we're seeing right now. We've got much more of your markets action ahead. Stay tuned. You're watching Catalyst. Now time for some of today's trending tickers, and a note for you viewers. Throughout the trading day, you can track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. Scan the QR code below to check out the latest. All right, let's go to oil markets here. They are ticking slightly lower after Morgan Stanley revised its oil price forecast downward yet again in the last few weeks amid demand concerns. We've got Yahoo Finance's Inez Ferre here to weigh in. She's been all across this one this morning. Hey, Inez.
Yeah, Brad, and we are looking at oil right now that's little changed, but Morgan Stanley is now looking for the fourth quarter of this year for the second time in about a month for Brent crude. So now Morgan Stanley sees Brent crude will average about $75 for the fourth quarter.
Hey, Inez?
That's compared to,
Inez,
yes.
Sorry, we're having some technical issues here, some problems with your audio. So we're going to try and get that squared away, and then we'll hopefully get back to you because we would love to hear the latest on that. Apologies for that. Hopefully we get that fixed right away. Let's move on to U.S. Steel because shares moving higher this morning after J.P. Morgan upgraded the steelmaker to overweight from neutral. Analysts at the bank saying that there is a buying opportunity in U.S. Steel after the White House objected to a $14 billion takeover by Japan's Nippon Steel, citing national security concerns. Of course, lots of questions about what happens next and where things go from here, looking at gains of just about 4%. But again, this decision here to kill the Nippon Steel deal could spark this legal challenge. So lots of questions about where it goes from here, how that legality will all play out. But again, we are seeing this move higher, and as a result, we are hearing this bullish call, or getting this bullish call, I should say, from J.P. Morgan.
Yeah, taking a look at the last 3 months, I mean, this has really been what we've been tracking just as to whether or not, and especially if you're looking at the tail end of that chart, just seeing where investors are anticipating this deal to ultimately net out, and decline like we've seen here would suggest that there's perhaps more value that should be and could be extracted from this. We'll see, but as of right now, at least in the near term, J.P. Morgan giving them a bit of an upgrade here on U.S. Steel right now.
All right, let's take a look at Starbucks because a share is ticking slightly higher this morning after former Chipotle executive Brian Niccol. Well, guess what? He's starting his new position as Starbucks chairman and CEO today. For more on what shareholders can expect is our very own Brooke DePalma. Brooke.
Good morning to you both. That's right. As you saw right there, this is really a new era for Starbucks, and investors are really hoping that Brian Niccol steps into this role and improves the value perception of Starbucks, as well as operational efficiencies that really Starbucks needs right now. So if we dive closer in, why exactly is this a new era, a new chapter for Starbucks? Well, we now know that Niccol will be the chairman of Starbucks effective today. This is a new era for Starbucks now that Melody Hobson, a Howard Schultz pick, who was formerly chair, has stepped down. And we can also see new Starbucks leaders come into play here. We know that Niccol has done that in the past at Chipotle when he took over following their E. coli breakout. We also know that Niccol will be remote in that Newport Beach area that he has resided in as Chipotle's CEO, and that could attract new talent in Starbucks, making their Seattle office perhaps a hub or a secondary, always, of course, their headquarters, but really could attract new talent, being that he's staying in California. We also are hoping for a renewed focus on value perception, this premium product that Starbucks is known for, but it has certainly lost that after price hikes, as well as various other opposition to the prices that Starbucks has implemented in recent years. And this menu innovation that Starbucks is known for, they've introduced things like the energy drink and lavender in the past year, but with so much cadence, one analyst told me that while people liked the drinks, they didn't market them efficiently. And that's really tapping into Niccol's sweet spot here. In addition to that, operational improvements, something that Starbucks really, really needs here. We know that Niccol has time and time again proved that Chipotle could be efficient in terms of introducing a dual-sided grill to increase cook time, as well as that digital make line to improve Chipotle takeout. And this really comes at a critical time for Starbucks. As you can see, shareholders really unsure of the direction of Starbucks here, but certainly optimistic once the announcement of Niccol coming in was announced earlier, or rather last last month. And this comes at a time where we saw same-store sales down 3% for the second quarter in their recent results. He's also expected to host a town hall this week, and we know that he's been going to Starbucks, really diving in headfirst to learn more.
Has he himself been doing some barista work?
Not yet, but I think he is suspected to be. I think that you will see Brian with a green apron on. He is jumping right in, and he's really, from what I hear, he's all hands in right away, really looking to understand how to fix this problem.
Oh yeah, gotta know how the coffee's made. I mean, real question that I wanted to ask you though, Brooke. I mean, for investors out there that have tracked his tenure at Chipotle and are no stranger to this man who knows how to execute some limited time offers, how's that expected to really translate over to Starbucks? I mean, what was the net end of the day percentage gain that shareholders saw while he was at Chipotle?
While he was at Chipotle, shareholders saw a 770% increase in the stock price. And when you think about that and how that translates to Starbucks, in the past 5 years, Starbucks has certainly underperformed. Taking a closer look at Yahoo Finance ticker page on Starbucks, in the last 5 years, Starbucks shares are down roughly 5%. And so investors are hopeful that he's going to step in, he's going to fix the problems in terms of menu innovation cadence, operational efficiencies, and also this tension that exists between their employees and leadership in hopes that they sort of move past these unionization problems that have been in the background for quite some time. And when you think about the leadership changes over the past 5 years at Starbucks, we had Kevin Johnson, we had Howard Schultz back for the third time in a row. Then we had Lakshman Narasimhan, who was ousted in August, and now Brian Niccol. Really, investors hoping that this is a clean slate, a new chapter for Starbucks.
Yeah, trying to close the revolving door there at the CEO position. Brooke, thanks so much. Appreciate it. Well, coming up, everyone, we've got a busy week of economic data ahead. We'll break down expectations and what it could mean for the Fed's next move. We've got an economist on the other side of this short break. Stay tuned. You're watching Catalysts.
After Friday's labor print, New York Fed President John Williams saying that current economic conditions call for adjusted monetary policy, noting that, quote, the risks to our two goals are now in better balance. This week, investors will get a read on the other side of the Federal Reserve's dual mandate with CPI and PPI inflation prints. Here to discuss, we want to bring in Preston Caldwell, Morningstar's chief U.S. economist. Preston, it's great to have you here. So I think the big debate is whether or not the Fed is likely to ease gradually or if it makes more sense maybe to front load some of those rate cuts. What do you think and why?
Yeah, so I mean, there's a significant number of market participants who are expecting a rate cut of 50 basis points in the upcoming meeting. And indeed, the typical market participant expects at least one 50 basis point rate cut by December. But I don't think that's likely. I do think the Fed will cut every meeting the rest of this year, but just by 25 basis points each. I don't think they're in that much of a hurry. You know, for one thing, the bond market has already started to price in to a greater degree more rate cuts than previously. So that means bond yields have fallen. And that will already start to work its way into the economy, stimulating borrowing and other aspects of the economy. So that's kind of actually already front-loading the impact of monetary policy easing and reducing the need for the Fed to hurry. And I also don't think that the labor market is about to fall off a cliff.
Okay, and so if not about to fall off a cliff, maybe then just kind of get to a normalization point. And if so, what does that normalization look like?
Right. So, I mean, I think we have been on the path to normalization, you know, insofar as this, these, record high job openings that we saw and a very high rate of hiring has gone back to normal. And so as a consequence, wage growth has trended back to levels consistent with 2% inflation. So we're really most of the way normalized in the labor market now. We have seen this recent uptick in the unemployment rate triggering the so-called SOM rule. I'm not as worried about that as some people are. I think to the extent that it's real and to be clear, the underlying source data from other parts of the jobs data is pointing in a contradictory direction to some extent. But to the extent we do have a genuine increase in unemployment of that magnitude, I think it's driven chiefly by increased labor supply and not by layoffs. And so we're not likely to get into this vicious cycle, or certainly we're not right now in this vicious cycle of job cuts and cuts in spending that tend to accompany layoffs that can really destabilize an economy.
So, Preston, then what do you think economic growth will maybe more accurately look like then here over the coming quarters?
Well, I do think we're headed for a mild slowdown, but GDP growth was at 3% year over year in the second quarter, so it's still very strong. And again, it would be odd to have the labor market collapse even while GDP is growing strongly. Normally, the labor market is a lagging indicator with respect to GDP growth. But yeah, we do expect GDP growth to trend down to roughly 1.5% year over year by the third quarter of 2025. So that should be sufficient to extirpate any of the last remnants of high inflation. Because even though it's not a recession, even though it's still in positive territory, it's below the potential growth rate of the economy because we're seeing very strong productivity gains, strong labor supply additions. So the economy is capable of growing at 3%. If we grow it at merely 1.5%, we'll create some slack in the economy and bring prices down or bring inflation down further and assure the hitting of the Fed's 2% inflation target.
So is employment the biggest kind of task or at least the biggest challenge to inflation at this juncture, or is there something else?
Well, no, I would say, if you just want to break it out, the biggest obstacle is housing because core PCE inflation as of July was about 2.1% year over year, excluding housing, whereas housing inflation is still running at about 5% year over year. So that's been the main driver. And, we still have very good leading edge data that indicates to us that housing, disinflation is right around the corner, with, rent growth on average, looking at kind of the third party indicators that are out there up about 2% year over year. So we know housing inflation is going to come down. And when it does, it will bring the overall core inflation index with it. But, I think we do need a little bit of, it would be good to have a bit of extra assurance that inflation is going to durably remain at that 2% target. And by achieving a mild slowdown in the rate of economic growth, I think the Fed will achieve that for sure.
Housing inflation going to come down at what pace from your expectations?
Well, I think it will, so in the last 3 months, we were running at about a 4.4% annualized rate of housing inflation. So, I think that will be in the 3 to 4% range in the last several months of this year. And then we'll drop down to about a 3% pace or slightly below in 2025. So I do think it's coming right now. We have already started to see some better months in terms of a bit lower housing inflation play out in the data. So it does look like that trend is getting started again already.
Preston Caldwell, who is the Morningstar chief U.S. economist. Preston, thanks so much. Teeing up what's going to be a big report that we're going to be tracking here this week with CPI. Appreciate it.
Thank you very much.
Certainly. Coming up, Google back in the legal hot seat today. The tech giant facing claims it has illegally maintained dominance in the online ad space. We'll discuss with someone who used to work in the DOJ and the antitrust division. That conversation after the break.
Big tech is under scrutiny. Google's second antitrust trial in a year is about to get underway in Alexandria, Virginia. Google is defending itself against claims that it has illegally maintained dominance over the online advertising market, and that has led to higher prices for customers. The start of the trial comes a little over a month after a judge ruled that Google's search and ad businesses violated antitrust law. Here with reaction is George Allen Hay. George is a professor of law and economics at Cornell Law School. He's also a former chief economist for the Department of Justice's Antitrust Division. George, it's great to have you here. And just by your accolades, you are the perfect person to talk to about this. So first, to start us off with the significance of this trial, because in the past, when you take a look at at least the share price reaction, it looks like investors have very much shrugged off some of the regulatory pressure in the past. Is it different this time, and why?
This case is a little different from some of the other cases. It's a bit of off the map. This is not something which is seen regularly by consumers. We know what we know what the result is of Google being a monopoly in search, but this is back office stuff. This is how the advertisers get put together with the web producers to place ads, and so it's not really caught the public's attention.
Well, so it comes back to acquisitions, though, that they've made, right, to make sure that they could really entrench the ad serving capabilities and ultimately the ability for advertisers to come in, bid in, and ultimately be able to perhaps try and get the best price that they can. But I mean, there's so many, to your point, layers to how they've kind of secured their position and really cemented this duopoly that became Facebook and Google for so long. So is there any breakup or unwinding of that specific part of the business that has a larger financial implication for Google here?
Well, certainly you're right. The case does involve, in part, some acquisition made a number of years ago. Interestingly, both of those acquisitions were approved by the government at the time. And so part of the challenge for the government will be to explain why they want to come back and get a second bite of the apple. But at the end of the day, if Google is found to be an unlawful monopolist, one of the remedies that the government will seek will be some kind of divestiture. Now, so much has happened since then. The companies that were divested are not the same as that part of Google now. But one can imagine some form of divestiture, which would be simply a part of the remedies that the government will seek. And yeah, it would be significant, but it wouldn't be backbreaking. Google could survive.
And George, you said that's part of, or some of the maybe the remedies that the government could seek. What else does that look like? I mean, we're trying to figure out consequences of this. I guess how significant could that be, or how big of an impairment could it be to Google's growth down the line?
Most of the time, the remedies are don't do this anymore. So, for example, in the early Google case, a lot turned on contracts between Google and Apple and other producers. And clearly what's going to happen at the very least is those contracts are going to have to be unwound. The contracts that gave a Google default placement on the browser. So there's some behavior that Google's alleged to have engaged in to try to prevent competition from coming in. There have been competitors that have tried to carve out a space in this business of matching advertisers and web producers. And Google, according to the complaint, has acted to suppress those entrants by various means. And so one remedy would be you can't do this, you can't do that, you can't do this. Whether that's going to be enough to restore competitive conditions, that's something the judge is going to have to be going to have to deal with. The government may well say, no, we need more than that. We need something more substantive. But divestitures are very, very rare in antitrust cases. They happen only in extreme cases. Normally, the judge can find some conduct which, if you change, will solve the problem. Like, for example, undo the contracts in the of Google and Apple.
It seems like there's been an uptick, and notably in maybe just the companies and the headline companies that have come out and have had to go through a lot of the litigation or the proceedings as a result of these big tech crackdowns. Is that just the new normal, or is that because of a certain person overseeing these departments?
I think it's more the former. That is, I think about, let's say 5 years ago, the antitrust community more or less woke up to the fact that, wait, we've got these huge platforms out here that really haven't been taking a close look at from an antitrust perspective. And so there was more or less a consensus reached and it even predated the current administration, that we really need to, antitrust people need to take a close look at these platforms. I credit Lena Khan, the current chair of the FTC, Senator Klobuchar, and others, to really, kicking us in the pants and saying, get a move on. And so the government, both the FTC and DOJ, began investigations, and in fact, they've now found things. So I don't think it is a political matter. I think it's simply that we woke up to the fact that purely from a straightforward antitrust matter, there are some potentially serious problems here that need to be addressed.
George, what do you think? I guess when we're trying to get to the heart of the issue here, what regulators should be focused most on or are focused most on, is it how these companies are exercising the power that they have, and how difficult is that to really prove here when you talk about the fact that Google, obviously far from the only tech giant that is facing regulatory pressure?
The main issue in monopolization cases is how you got, if you have a monopoly, if you don't face serious competition, how you got there in the first place and how you stay there. How do you prevent new entrants from coming in and taking away your market share? The important thing to realize is that this is very unlike a burglary. A burglary, you break into a deserted house at night, you know it's illegal, but you hope you're going to get away with it. You hope no one will find out about it. Everything Google has done over the past 20 years has been done more or less in the public. They've thought about their conduct with the advice of antitrust lawyers and economists. They pretty clearly believe they have good answers to the DOJ's questions. And that's how it's going to play out. I mean, they will say, yes, we did this. No, we didn't do that. The things we did, we can explain why they're not anti-competitive, why they're legitimate business practices. That's the challenge for a court. Unlike a burglary where all you have to do is catch them.
All right, well, George Allen Hay put it pretty simply there for us. Thanks so much for hopping on with us. Of course, we will be tracking the latest developments from the trial as it gets underway later on today. George Allen Hay, he's a former chief economist for the Department of Justice's Antitrust Division. Thanks so much.
Thanks for having me.
Coming up, most investors are pricing in a 25 basis point rate cut at the September meeting next week. But our next guest saying that might not be enough, at least for the markets. We're going to find out why on the other side. size of a rate cut at next week's meeting here by the Fed? Well, it's up for debate on Wall Street since that weaker than expected July jobs print. Now, the August report offering some mixed signals with non-farm payrolls missing expectations, but unemployment ticking lower to 4.2%. Rate cut expectations seesawing on the back of that print. Traders right now pricing in a 75% chance of a 25 basis point cut next week. If this bet turns out to be right, our next guest warning that we actually could see a big pullback here for the markets. Joining us now, we want to bring in Brian McCarthy. He's the chief strategist and managing principal at Macro Lens. Let's talk about maybe, Brian, the size of the pullback that we could see in the markets. Walk us through why this could be a risk here or a catalyst to the downside for U.S. equities.
Yeah, I think U.S. asset markets are increasingly concerned that the Fed is behind the curve. So we can go back to the sharp volatility we had in the beginning of August when some went into the FOMC meeting at the end of July, like ex-New York Fed President Bill Dudley, who had been very bullish on the economy, saying, you know what, they should probably get started with 25. They did nothing in July. We got a weak payroll number, and the market said, wow, the data's weakening and the Fed is not responding. And I think they're about to repeat that mistake because we got clear messaging from Fed Presidents Goolsbee, Williams, and Governor Waller on Friday that they all prefer to start the cutting cycle next week with 25 rather than 50. And, you know, we've seen pretty persistent weakening in the payroll numbers. So I think it's pretty likely that this meeting will be followed early next month with another weak employment report. And we're going to sort of repeat that volatility event we saw in early August, with the market really concerned that the Fed is behind the curve, which I think they are.
So, Brian, then how weak do you think the unemployment or do you think the employment picture is going to get here in the U.S.?
Yeah, there's been pretty severe weakness throughout the job market all year long, which has been disguised by outsized hiring in the government and healthcare sectors. And, you know, the government hiring is boosted by some of the fiscal expenditure, the bills we've seen passed in the last couple of years. But to some extent, both the government and healthcare hiring aren't really indicative of demand pressures. Those are sectors where the job listings were there 2 years ago. There were no bodies to fill those seats, whether it was continued post-pandemic healing or immigration or some combination of the two. We've seen a big boost in labor supply and outsized hiring in government and healthcare, but that has masked very weak hiring throughout the rest of the economy at levels like quite a bit weaker than the last economic cycle we saw prior to the pandemic, which was very weak. So the weakness has been there. Now you see healthcare and government hiring start to normalize, and the weakness is starting to show up in the broader numbers.
I want to go international here for a hot second as well while we have you, Brian. Chinese markets particularly, they closed lower as deflation fears, they're lingering there. Consumer prices rising at a slower pace than economists were expecting as well. Citigroup, now the latest big bank to trim their expectations, you may have seen, for the Chinese market here. Walk us through your estimations and what you're anticipating out of the region that's trying to really figure out where they can bring the consumer engagement back higher.
Yeah, I've been consistently bearish on Chinese economic growth for about 2 years now. Since it became obvious that their housing bubble had busted and was not going to be reflatable. And this has put the Chinese system, which is saddled with very, very high debts that funded very poor quality investment. It's saddled that economy with a debt deflation problem that history shows, whether it's Japan in the 90s, the US in 1929, the West in 08, you cannot get out of this trap without very, very aggressively easy monetary policy. In China's case, they are reluctant to get rates lower. Rates are just below 2%. They can't really push them to zero because all of this debt has been funded by household bank deposits, and the households will get really upset if you tell them you're going to pay them zero on that money. The only way China breaks the debt deflation would be a big burst of reflation coming from a sizable devaluation of the RMB. But they're very reluctant to do that for a number of reasons, some of which are geopolitical. So China is stuck There is no fix for what ails China, absent a significant devaluation, in my view. But once they decide to go down that path, it's going to be highly destabilizing. And just to bring it back to the Fed, if the Fed does make a mistake of being behind the curve, technically that's going to mean even while they're easing, they're still too tight. That is going to put pressure on the RMB. It greatly exacerbates China's problem. So if we get a big risk event in the US where the dollar tends to rally and global credit tightens, China is like a powder keg on top of that situation. You'll see pressure on the RMB and serious volatility in Chinese equities.
What does that mean for US equities that are most exposed to China's economy?
Yeah, well, we've seen, earnings in the Chinese equity market are, I think, down 4 or 5% year on year. So there's already the domestic equities in China are showing that there's serious pressure on consumption rates and spending in that economy. And a number of companies from Nike to Apple have suggested that they're seeing a similar phenomenon. So it's really not a great place for foreign multinationals to be doing business. And that's before we even get into the wide array of sort of political and geopolitical risks that surround being exposed to China. So I think both from the terms of multinational, real investment, inward investment in China and financial flows, I think China is going to remain hands off for most foreign investors.
All right, well, Brian, we've also got the presidential debate tomorrow night. And of course, China will likely come up as a topic here. We've heard some tough rhetoric on both sides when it comes to Kamala Harris, but also more specifically from former President Donald Trump and maybe what he plans to do tariff-wise. How should investors, or I guess, could a Kamala Harris victory, could that benefit China? Or is it almost a lose-lose scenario regardless of who wins?
Yeah, I think the bilateral strains are going to exist under either administration, but I don't think there's going to be much change in the near term either way. If Vice President Harris gets elected, I think we assume sort of a continuation of the Biden policy, which is to not touch the Trump tariffs, not really add much meaningful in terms of additional tariffs, and with mixed success, try to prevent China's ability to obtain higher end technologies that can help them in defense and other key areas. So, you get that continuation with Harris. Trump, probably less on the semiconductor stuff. And I think less in general, actually. I think this might surprise people. But I don't think China, having a fight with China is going to be high on President Trump's second term agenda early in the term, particularly with the kind of weakness I see unfolding in the U.S. economy early next year. So I think it's sort of maybe a 26 or 2027 story should he decide to, again, try to get China to alter its fundamental economic behaviors by threatening tariffs, which doesn't really have high odds of success. So I actually think the surprise might be Trump, probably a lot of talk, but I'm not convinced there'll be a lot of action early in a second Trump term, if that's what we get.
Brian McCarthy, Macro Lens Chief Strategist and Managing Principal. Brian, thanks so much for taking the time here, laying this all out with us today. Appreciate it.
Thanks.
Certainly. We're taking a look at some trending stories here, starting with Barclays analysts downgrading 3 retailers, Adidas, Burberry, and Kering, citing weakness in the Chinese economy. This comes after the analysts spent 2.5 weeks in China and said the sentiment seemed more cautious than 6 months prior. It's also worth noting that for the consumer in the Asia-Pacific region, and especially in China, there has been a noted sense that there's more annexation of the mind share to some of the homegrown brands, and that's certainly impacting some of the more international companies in that region, Adidas, and then additionally Burberry that you were seeing there on the screen, Kering included too, slipping.
Yeah, we have certainly seen a number of retailers come out here over the last several quarters talking about the sluggish growth in China, the fact that the recovery that many had expected is taking much longer to materialize. And as a result, many companies, even those larger Chinese companies, especially e-commerce giants within the region, they're repositioning their business just a little bit to accommodate for what has proven to be much slower growth than anticipated. So again, a downgrade here from Barclays on these retailers, not necessarily a huge surprise, given the fact that even what we just heard from our last guest, Brian, they're telling us that the sluggish recovery that we're seeing here in China will likely likely take longer to play out, will likely be longer until we see any sort of movement or regaining here of momentum. So as a result, many of these companies and many luxury companies, specifically higher end retailers that have exposure and rely heavily on Chinese spending, could then, as a result, be pressured here in the coming quarters.
Yeah.
All right, well, one thing that luxury consumers are spending on is the U.S. Open. We had the finals, the men's finals yesterday on Sunday over the weekend. Ticket prices for the finals and for the semifinals got up into the multiple thousands. I'm hearing here some notable attendees. We had Taylor Swift there. She was there with Travis Kelce, to no surprise. A number of celebrities were there over the weekend. But again, why we're talking about it is because the sheer amount of money that people are willing to spend, or their companies are willing to spend, to send their employees to the U.S. Open. You talk about the fact that tickets were in the thousands of dollars.
Tens of thousands
of dollars. You contrast that with the weakening, quote unquote, weakening economy. They're a bit of a surprise that people are still willing to pay, obviously coming from that very, very high-end consumer.
Yeah, I'll tell you what, the future of the Open and future of tennis in a lot of great hands in terms of the players themselves. We had an exciting men's semifinal that I actually had simul tuning in with the Eagles game that was in Brazil, which our executive producer just informed me did not know was on Friday. A lot of people wouldn't have been surprised to hear that. Us Eagles fans, we knew it was in Brazil. But anyway, aside from that, was watching that at the same time as I was watching Tiafoe go up against, oh my gosh, who was the player that he went up against? Fritz. Taylor Fritz. And then additionally, Fritz, unfortunately losing to Sinner, who was number one ranked, I believe, coming into the start of the tournament. So all that said, ticket prices were high, tennis talent was high, and the fan experience, that too, was high.
Excitement was high.
Excitement.
All right, well, coming up on Wealth, you want to take it? It's you.
It's me? All right, well, I'm going to have all your personal finance needs. Brad Smith, me, has you for the next hour. Stay tuned. Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, tools, tips, and tricks that you need to grow your money. Hey, on today's show, navigating your stock portfolio during some volatility. We'll get advice from one portfolio manager and some potential stock picks for you. Plus, Wall Street pricing in a rate cut from the Fed in September. We'll talk about what that cut means for your credit card. And a new school year is kicking off. So we're bringing in an expert to give you and your kids the money-saving hacks all college students should know. We've got all that and much more during today's show. But first, let's get to a market check here as we're 90 minutes into the start of today's trading session here. Stocks, they're rising, rebounding from last week's big sell-off. And September is famously a weaker month for stocks. We've already seen a lot of volatility, maybe concerning some who stare at their brokerage and retirement accounts. Our next guest says it might not be over. Here with more, we've got Jeremy Bryan, who's the senior portfolio manager at Gradient Investments. I mean, we were all hoping that some of this volatility is over here, but what are you seeing from your lens, Jeremy?
Yeah, I don't think the volatility is over yet. I think we're going to bounce around, but I don't think we're going to have a sustainable trend in either direction. I don't think volatility necessarily means disaster, right? That's not what we're saying here. What we're saying is expect the markets to be choppy. We're gonna trade on a lot of data points here over the next couple of months because we don't have earnings until probably the middle of October to kind of tell us what the consumer sentiment and all that stuff looks like. So we're really trending off of the recent jobs report, what inflation's going to look like, and probably most importantly, what the Fed is going to do at the end of this month. So those are the kinds of things that we'll see ups and downs from, in September. And September, just in and of itself, just for whatever reason, tends to be a slower month and a little bit higher volatility as well.
And so with that in mind, I mean, the September effect is what we've been having the jitters about as of whether or not that will hold supreme as it has in years past. Is that what's formulating from what you're seeing in the mix right now? And how much does the Fed decision that's coming out next week, how does that really kind of push the dial one way or the other?
Yeah, I mean, right now, the probabilities are for 100% for a cut. It's just the magnitude of a cut. So 25 basis points or 50 basis points, which one are they going to do is kind of the thesis in the market right now. So any, real volatility and what I would say pretty negative volatility will come as a result of them saying they're not doing anything. So the market really assumes a cut right now. And so you have to assume that if they're not going to, for whatever reason, they better be out communicating that pretty quickly because the market expects it. And so from our side, the volatility really comes from, like how much of that magnitude of the cut looks like. If they go to 50, the subsequent data points that we're going to see in economic data before they do it, that's also going to have some indication about, are they slowing enough to where 25 basis points is enough? That's the most likely outcome right now. Or are we deteriorating faster than they think and they need to boost it a little bit more and do a 50 basis point cut? So it'll be interesting from that over the next few weeks. But, from our side, we still think a 25 basis point cut is the most likely.
With that in mind, I mean, and as we've been discussing here, and UBS actually noting within their own release this morning saying and talking about how U.S. equities are falling on that mixed U.S. jobs data. And they put within that publish here that the weaker pace of job creation rather than more encouraging aspects of the report, such as a decline in the unemployment rate, that actually had really had more of the outsized effect that we've been discussing here. In the event that we do see continued jitters off of not just what the employment situation is telling us, but perhaps what shows up in CPI later this week, where are those dips and those dip buying opportunities from your perspective as you're kind of looking across where the market could continue to have some unease around the economic data readings that do come out?
Yeah, I think, stocks certainly are not in the bargain bin. Yeah, I mean, there's just no, I can't argue for that at all because we're at elevated valuations still at this point from the S&P 500 as a whole. And we're still up over, in the double digits for the year so far, even though we've come down here a little bit. So from that perspective, we could see further declines. But I would say anything in that true correction territory, that 10% plus correction from all-time highs, I would be looking at that and saying, okay, are there anything that has been overreacted during that time as potentially the opportunity to gain up going forward? in this time right now, I mean, if people want to play defense, I think there's no better place to play than defense right now. Defense stocks like Northrop Grumman, like L3 Harris, like Raytheon, those companies are at reasonable valuations already, and their growth profile isn't subject to these things that we're talking about, is that they have different trajectories, and they should be okay given the current environment.
And so, as you're leaning further into defense, where would you be taking chips off the table?
Yeah, I mean, look at, what I would say is you have to examine your portfolio in and of itself. And how much risk are you taking in some of the stuff is that we saw massive chasing of the AI stocks, right? And I'm not saying the AI stocks are bad. In fact, we own plenty of them here, but we don't own them to the extent that even the S&P 500 has them. We're underweight Nvidia, we're underweight Apple. These kinds of things, just from a perspective in saying their weight is so significant and they've had such a significant rally, that's an area where I can take some profits from to relocate them into other areas.
Jeremy Bryan, who's the senior portfolio manager over at Gradient Investments. Great to kick off the week with you. Thanks so much.
Thank you.
Certainly. Coming up, a rate cut is going to come, but how much of an impact will it really have on your current loans and credit cards? We dive into that next on Wealth ahead of next week's big FOMC meeting here and what it means for your credit cards as well. Stay tuned. The Federal Reserve is expected to cut rates by at least 25 basis points at its meeting next week, September here, and midpoint of September. A lot of investors are excited because this could mean lower borrowing costs for businesses and consumers going forward. So How big of an impact will this have on you and your credit card? Here with some answers, we've got our very own Kendall Little. Hey, Kendall, so what type of change should people ultimately anticipate here?
Yeah, so just to give a little bit of context, this period of higher interest rates has been tough for a lot of credit card holders. We've seen balances growing, we've seen delinquencies on the rise. Just last year, credit card total debt hit $1 trillion. And then if we look at interest rates, back in 2022, before the current rate hike cycle, average rates were around 16%. Now they're closer to 21% and rising. And we've seen credit cards with APRs that are even closer to 30%. So all of that adds up to a pretty tough cycle for credit card holders. But the important thing to remember is that the Fed's moves are only one part of what determines your credit card interest rate. So, whether the Fed lowers rates by 25 basis points, by 50 basis points, historical data shows us that that probably is not going to have a very significant impact on what your credit card interest rate is.
So if someone has credit card debt, what should they do now before the Fed cuts rates?
Yeah, so today and every day is a great time to really start taking action to eliminate that credit card debt. Really make the moves that are going to start getting those balances down while credit card interest rates are high. One way that we really recommend and that we like is a balance transfer credit card. These credit cards offer 0% APR for typically between 12 and 21 months. So that means that you're going to have over a year with no interest charges on that balance. You can really work toward getting it down. You do have to think about balance transfer fees, but that 3% to 5% fee is really nothing compared to the interest charges. Another consolidation option for some people is going to be a personal loan. You're not going to find a 0% personal loan, but personal loan rates are typically much lower than credit card interest rates. So again, you can save on those interest charges. And then the last thing that you really should make sure you're paying attention to is stopping that overspending in its tracks. So while you're taking on, this period of paying down your debt, you don't want to add to the debt. So if that means starting to spend more with cash or using a debit card, you might forfeit some rewards, some cash back, but again, that's going to be a lot less of a hit than the interest charges that you would have.
Kendall, thanks so much for taking the time with us as well. This is going to be something major to track here. Lastly, maybe we can insert this into the chat just before we let you go. From credit cards to loans as well. I mean, how should people be thinking about their loan strategy right before this potential interest rate cut?
Well, I think it's going to depend on whether you have a variable rate loan or a fixed rate loan. So credit cards are variable, so that means that, the rate can change. But if you have a fixed rate loan, it might have less of an impact. But either way, the higher your interest rate is going to be, you're going to want to make sure that you're paying those down as quickly as possible.
Kendall Little, Yahoo Finance's own, always ready for any topic that gets her thrown her way. Kendall, thanks so much.
Yeah,
Appreciate
of course.
it. All right, let's continue this conversation from credit cards to loans. Just because the Federal Reserve is expected to cut interest rates next week doesn't mean you'll get a deal if you wait to take out a longer-term loan. Joining us now to discuss is Kelly Shue, who is the professor of finance at the Yale School of Management here. Great to have you here with us. So first and foremost, you heard our discussion there just a moment ago. How should people with outstanding loans be preparing for this potential rate cut coming in September?
Thank you, Brad, for inviting me here. I did want to just bring people's attention to this idea that what my research shows is that it is a mistake to wait until an expected Fed rate cut to actually go and take out a long-term loan. And the reason is the interest rate on any long-term loan is forward-looking. The interest rate on long-term loans, such as mortgages or long-term personal loans, they have already dropped to factor in market expectations that the Fed is going to lower interest rates this month. So unless there's a surprise in which the Fed lowers interest rates more than markets expected, the interest rates on mortgages and other long-term personal loans are not going to fall further. They've already dropped. So there's no reason for households to wait.
And with that in mind, what type of loans most notably are going to have the impact that you're talking about, where even if we do see rate cuts and a pathway forward for continued rate cuts, the loans that won't have any type of net or delta from today versus if you were to take out that loan 2 months from now?
So any type of long-term loan, I would say a year or longer, expectations of Fed rate cuts have already been priced in. Basically, the bank on the other side offering us these loans, they have the same information that we do, that the Fed is going to lower rates. They've already priced that into the interest rate of long-term loans. Now, it is true if you're going to get a short-term loan, for example, a credit card with a variable rate tied to the prime rate, that could actually drop after the Fed cuts rates.
Okay, and so with that in mind, I mean, you have a lot of people that are trying to figure out how this also might impact their mortgage rates, and if they're going to apply for a mortgage rate, whether they should do it now versus when the Fed starts to cut rates. What is the thinking going into the approval process, or at least the applicant process for those rates, and waiting versus not waiting?
In some ways, I think the rational, correct way for consumers to behave is actually not to worry about timing interest rate markets. And that is because the current interest rate in the market for any long-term loan already reflects all the information we have about what the Fed is likely to do in the future. And therefore, for example, if you think that the Fed is going to raise interest rates, there's no reason to rush in and get a mortgage now before the Fed raises interest rates, because interest rates have already risen on the news that the Fed is likely to increase rates. And similarly, now that we're in a cut cycle, there's no reason to wait to get a loan until the Fed actually goes out and cuts rates. Long-term rates have already fallen. Okay. Now, this actually means the job of a typical household is actually much easier. Just don't worry about the timing. All of the information that we have has already been priced in.
Okay, and so with that in mind now, looking ahead to the monetary policy, what are your anticipations for the size of a cut we could get, and then ultimately what that spells out about the economy too, because that still has some larger implications for the amount of loans that people might feel like they need to get to stave off any hit to their own financial balance sheets?
I tend to believe what the Fed is saying. The current Fed has a good track record of giving us pretty reliable guidance. They're hinting at a rate cut. I would be surprised if it were a 50 basis point rate cut. That's probably larger than what they're going to do, but it's a possibility.
All right, Kelly Hsu, who's the Yale School of Management Professor of Finance. Great to have you here on the program with us. Thanks so much for the insights.
Thank you, Brad.
Certainly. Everyone, we've got much more wealth after the break. Stay tuned. You're watching Yahoo Finance. According to data from FinAid, college is expensive and it tends to rise about 8% per year. The average American spending more than $25,000 annually for undergraduate tuition and other costs like room and board. That according to the National Center for Education Statistics. And as a college student, it's important to learn how you manage your money. So you could end up with some unpleasant surprises at the end of the semester if you don't do so. For more on how students can create a sustainable budget, we've got Winnie Sun, Sun Group Wealth Partners Managing Director here. Winnie, great to have you here on the program with us. So first and foremost, I mean, we talk about the ways to make college a little bit more affordable here. What are some of the top areas that students and families as well would be apt to chart out and look at?
Thank you so much, Brad, for having me. Absolutely. It's an exciting time for families going back to college or going to college for the first time. And so there are a couple things that, you're a student and you can do now to help with that situation. One of the best things I like to do is to make things simple. You're juggling classes, you're trying to figure out the whole dorm life. So we want to make things that are sustainable. And the first thing you want to do is to find yourself a money buddy, or what I call a money tribe. So some people maybe in your dorm or in your social circle who are also focused on saving money. This is a great time to be that a poor college student that isn't really poor, but that is really focused on saving. And the other thing I would say is to think about prioritizing you. You want to set a monthly and annual goal and ask yourself, how much would you like to save every month? And prioritize this. And so you're making what could be a negative, like being on a budget, and turning it into a positive, saying, hey, I'm going to be saving X, Y, Z for this particular goal. And that could be the vacation fund. It could be paying off your student loans more quickly, even before graduating, and sort of changing that mindset and sort of prioritizing savings.
And so with that in mind, as you're thinking about the areas to kind of cut down on your costs, a lot of people think about all of the expenses that they're navigating through when they're in college as well. What are some of those top expenses and where they should be trimming students should be?
Sure. Well, Brad, Kendall said it great earlier about credit cards. And I think that's something that I want to sort of just touch on really quickly. When you're thinking about these large expenses or expenses during college, we also want to figure out a way of how we're going to pay that, whether it be paying with a debit card or with a credit card. Whatever you want to do, you want to make sure you set it up, the banking app or the credit card app, to give you a push or text notification every time that you spend, and also remind you on when to pay. So you want to think about not only the big things, but also the little things. So the big things are things such as your housing. So how much you're paying for maybe your dorm or that off-campus apartment, and figure out ways that you can get that fee chipped down. It could be working in your dorm as maybe access control. You could be working in the cafeteria, and that could help subsidize your housing costs, maybe even in the future being a resident advisor. The other thing you want to do is once you leave the dorm and you go to class, obviously you're going to get hungry, you're going to get thirsty, and those little expenses are things that are like the adult's version of Starbucks coffee. So instead, make sure you go to your cafeteria with a Ziploc bag and a refillable water bottle. And that way you can pack a snack, you can fill up your bottle, so that you want to try to strive for not spending money every week. Challenge yourself. They're like, you know what? Besides my fixed costs, I'm going to try to reduce what I don't need to spend and just get kind of creative and make it fun.
Winnie, we were just showing it there on the screen a moment ago and kind of teasing what my next question was, but specifically talking about if you're looking for a job in college too, some of the best areas that you could potentially work in or roles that you can potentially work in, especially when you're kind of trying to maintain that student balance as well. What are some of those jobs?
Well, Brad, I'm with you. And, so often I hear parents say, I just want them to, go to college and focus on their studies and whatnot. But let's be real, like when you were in college, when I was in college, we did have quite a bit of free time. And so again, you want to frame this as a positive. For students like myself, I had financial challenges. My parents went bankrupt right before I started college. So this was something that I really needed to focus on to bring in some money. And let me tell you, when you work and you find that job, whether through the internship office at your college or the local newspaper. And there's so many incredible resources online now. And you can fit that into your schedule. And not only will you be bringing in income, but you'll also be building a foundation, a resume, a work foundation for when you get closer to graduation. You'll have actually a leg up versus the many candidates then competing for that next, perfect job or, aspirational job that you want. So think about freelancing. There's platforms such as Fiverr, Wisent, where you can tutor online in your dorm room. There's all these other ways where you can work when you want to and just bring in that extra income, which can help your bottom line.
Winnie Sun, Sun Group Wealth Partners Managing Director. Winnie, thank you so much for taking the time and for the tips here on the day. Appreciate it.
Thank you so much for having me.
Certainly. Coming up, whether it's a new job, new spouse, or a new kid, we've got some tips to manage your money no matter what life throws at you. That's next on Wealth. A new job, maybe a raise, getting married, having a child, major life events like these can have a big impact on the money you make and how you spend it. Brandon Copeland is no stranger to these pivots. Since he's left the NFL, he's become a financial educator, husband, father, and now the author of Your Money Playbook, How to Earn More, Build Wealth, and Win at Life. Brandon Copeland joins me now. Brandon, first and foremost, congratulations to you and your wife. I understand you are welcoming a brand new family member and taking some time here with us on the day. We'll keep this as brief as possible and drop some nuggets for our viewers out there along the way. So first and foremost here, as we were talking about, life brings a lot of pivots here. What can people remember and keep in mind as they are navigating each pivot?
Yeah, I think first and foremost, when you're talking about the job pivot, you want to save up for that transition. I mean, a job pivot, I want you to save as much as you can in between those jobs because you need to have cushion just in case there's issues like a delay of payment or lapse of coverage of your insurance. So first and foremost, just making sure that you're buffering up that emergency fund, that savings account prior to that transition will give you more peace of mind as you switch over to your next career path. And then when it comes to relationships, now this is the scary topic for a lot of people, but this is one of the leading causes of divorces, finances and infidelity, right? And so it's important to get on the same page with your partner about finances as possible. So it's one, let's get on the same page. Let's at least be in the same chapter. And we definitely need to make sure that we're at least in the same book, right? But then two, are our goals matching and trending and tracking with each other? You have to actually have conversations about your money with your partner. You don't want to avoid those things. You don't want to have surprise bills because all of that can lead to resentment. Start with your 5-year plan. Where do you want to be 5 years from now, individually, but also as a couple, as a relationship? Where do you see your lives tracking together? And then work backwards from that and make sure that your 1-year plan, your 3-month plan are all laddering up towards that 5-year plan. And then get your money organized across accounts. People do it differently, whether you're going to have your bills all come out of one account or a joint account. It's important that there's multiple ways to do it. There's some folks who will tell you got to do it this way, you got to do it this way. Ultimately, you have to figure out what works for you. For my wife and I, we kept our individual accounts and we eventually created a joint account that we started to pour into from our individual accounts that we had before we were ever dating and married. And we use that joint account to now pay off our bills and things of that nature. But most importantly, we're organized. We know where every bill is coming from, and we can stay on top of each other to make sure that we don't have any issues.
Very wise. And additionally here, one of the other scenarios, the life pivots or, additions that can come along is when you're family planning as well. Managing having a child, something that a lot of millennials are thinking through. And with that in mind, what are some of the early steps that people should be thinking about, the costs as well associated when they are doing family planning?
Yeah, absolutely. I think first and foremost, thank you for saying congratulations to my family and I. We welcome Brennan Maverick Copeland to the world this morning. You still see the bags under my eyes. I've been up since yesterday, 6 a.m. yesterday. But first and foremost, you have to audit yourself. You have to get organized yourself. When you go into an airplane, they say, hey, put your oxygen mask on before you try to help anyone else. You need to make sure that your money is organized and your plan for yourself is in order. And then based on your situation, then it's time to game plan for your child's future. And that also is a conversation. That's figuring out, are they going to be in private school? Are we going to help pay for higher education? Are we going to be paying for the wedding and chipping in? Because ultimately the answers to those questions will help determine what you need to be saving and investing today to be able to actually write that check in the future. And at the end of the day, once you put your oxygen mask on, you've gotten organized, you figured out a plan for yourself. Now it's time to go to work. It's time to roll up your sleeves and start earning money and actually executing on that plan. And what I always like to say is the goal of a parent, and specifically I'll say me, the goal of me with my 3 boys is to give them options. I want to teach them the value of hard work. I want to teach them how to earn everything, and they won't need to touch mommy and daddy's hard-earned money. However, we want to make sure that they have options. We understand right now it costs about $16,000 to $18,000 per year to pay for a child. That's only going to increase over time as education costs and expenses continue to rise. And so what we are doing is we are putting our child's money into multiple accounts. We want them to have a traditional high yield savings account. We want them to have a brokerage account. We want them to have a 529, and I want them to have a Roth IRA. Depending on your situation, you may look at it and say, hey, I can't fund all of these accounts, and that's completely okay. The thing is, you're creating these categories and these buckets so that as you continue to evolve and grow your own financial journey, you can contribute to these buckets based off of what your goals for your child's relationship with money is. If you want to pay off their education sooner rather than later, then you're going to be over allocating towards that 529. If you want to go ahead and put some money away for them for retirement so it can just compound for their lifetime, then you may be putting some money into their Roth IRA. But ultimately, having these different options will give your child the fast lane pass to financial freedom one day.
Brandon, great advice there. Just lastly, while we have you, bit of a curveball, but not too much for you. I know it's something we've talked about before. We're talking about your money playbook, but a lot of teams are executing on playbooks right now as the NFL season has just started. College football season is back up and running again. And so all of this considered, I'm going to go to the college people first here. For those who have some NIL deals that are trying to figure out how to stretch their money, what's the best way they can implement a savings strategy at the same time while they're trying to generate income off of their name, image, and likeness?
Perfect. Well, first, I'm going to tell them go ahead and go buy your money playbook. Make sure they go buy that today, read up and invest in themselves like that. Two, I'm going to tell you, when you're in college, you have a lot of things that are paid for already for you. So you should have your meals, you should have your shelter and your housing and things of that nature. You need to be hoarding money. I know hoard sounds like a negative word, but when I was in the NFL, there were times where I would eat all of my breakfast, lunch, and dinner at the facility. I'd bring home waters and Gatorades from the facility to my house. If you came to my fridge, you thought it was the Detroit Lions practice facility fridge at times, because I was going to use my resources and save my hard-earned money because I knew one day I would actually need that money to live off of. And so for anybody out there earning NIL money, whether you're earning $100, $200, $200,000, make sure you understand that this money is going to be put towards the rest of your future. And so you need to think long-term with it. Save as much of it as possible. Please save as much of it as possible. Doesn't mean don't treat yourself, but when you're a college athlete, you are focused on your sport and living your dream, you can cut as many expenses as possible. You don't have the expenses of the real world yet. Save your money. Don't be buying multiple cars and things of that nature. Don't go crazy on jewelry. Save your money, because I promise you, I guarantee you, you will be so grateful that you did that in the future once you graduate.
Look, if I had a good NIL deal, I would just want to get the watch that Shadur Sanders has. Brandon Copeland, thank you so much for taking the time here with us today. Congratulations again to you and your family. Everyone can check out Brandon Copeland's latest book, Your Money Playbook. Good to see you.
Always.
A lot of consumers are attempting to keep their finances in check by pulling back on a lot of discretionary spending. Our very own Brooke DePalma got a chance to speak to Mark Barakas, who is the CEO of Shark Ninja, at the Goldman Sachs Global Retailing Conference last week about the state of the consumer. Take a listen.
Well, look, I think the consumer's been under a lot of pressure for the last couple of years, and I think they're very discerning, and I think they're making real decisions and trade-offs about where they're going to spend their hard-earned dollars. And for that reason, I think the playbook that Shark Ninja has of market-leading performance and high quality at an extraordinary value is something that's really appealing to the consumer in this time.
Yeah, it seems like if you look at your results, the outdoor grills, Ninja ice cream makers, people are still willing to buy it. Do you think you're immune to the slowdown? And how are you thinking about that going into the holiday and into 2025?
Well, look, I don't think we're immune to it. I think that we invest tremendously in R&D. We spend over 7% of our sales in R&D. We invest tremendously in advertising and marketing. We spend over 11% of sales in marketing. We have 7 times more social media engagement than our nearest competitor. I think our products are really part of culture, and for a relatively inexpensive price are able to elevate the consumer's home and allow them to be able to do things. And so when you think about a Shark or Ninja product, you might go out to dinner less, or you might go on less of a vacation. But for, as you said, $199, you can have the Ninja Creamy at home, or you could have the Shark Flex Style hair dryer for $299. So we like to think of ourselves as affordable, accessible innovation.
Yeah, speaking of, the Ninja Luxe Cafe costs $499. Do you think you have pricing power moving into the end of the year and into 2025?
Well, I think what it really comes down to is, are you delivering extraordinary value? And I think category to category, the definition of that might change. I think the average espresso maker in the United States today sells for almost $800. And all it does is deliver a 1 shot or 2 shots of espresso. The product you mentioned, the Ninja Cafe Luxe, delivers espresso, iced coffee, cold brew, drip coffee. We're from Boston and we go to Dunkin' Donuts in the morning and get 18 ounces of drip coffee. The Lux can deliver that. It froths hot or cold. It froths dairy milk or non-dairy milk. So I think it's really about, the versatility and the value of what you're delivering to the consumer. And I think that varies. And I think actually, if you look at the reviews of the Ninja Cafe Lux, you'll see that people actually say it's a great value.
Yeah, really is all about that value proposition. I do want to lean into another trend we're seeing, which is this better for you trend. It seems like this concept of protein ice cream has really taken off on TikTok in particular. How are you playing into this social media virality, and how do you get other products on this platform as well?
Well, I think a big piece of it is enabling the consumer to hack our products and to turn them into the things that they want to turn them into. We have a new product that we just launched called the Ninja Slushie. And it's everything from consumers putting orange juice in for their kids, all the way up to putting rosé wine in and making a frosé and everything in between. And I think what's great about these products is that the consumer can kind of make it their own and decide ultimately how they want to bring it to life and what outputs they want to have for them or their families.
I do want to broaden things out. You are a global company. You do play in China market as well. How is the consumer responding there? And are they still willing to splurge on these items, or are you seeing a slowdown there?
Well, our business, our international business is mainly focused in Europe and Latin America. We're growing in both of those markets considerably. I mean, we've had low market share. We've just gotten into many of these markets over the last 24 months. And we're seeing a lot of excitement. I mean, we think that our products are right for the consumer there. We're investing a lot in advertising. We're getting a lot more retailer placement in many of those markets. So overall, I mean, we think there's a lot of white space in these international markets for us.
How are you thinking about potential tariffs ahead of a Trump administration?
We think we're really well set up for whoever wins the election come November. We've been diversifying our supply chain outside of China for really the last 5 years. There are tariffs in place today, the 301 tariffs. They really have not impacted our business much. The majority of that product is able to be made today outside of China. So we're continuing to move our supply base and diversify our supply base. We intend to have all of our U.S. production made outside of China by the end of 2025. So regardless of who wins, we think we're well positioned in a global environment.
I want to take a look heading into the holiday, into 2025 once again. Will you play into promotions, into value-seeking behavior that we're seeing among consumers right now?
Fortunately for us, we drive a big proportion of our business at full price. Now, that's not to say we, of course, participate in all of the major events and all of the big shopping periods. So, yeah, I mean, we do intend the market this holiday season to be quite promotional. However, for our brands and our business, we're not expecting promotions to be up over prior year. We're expecting them to be about flat to prior year.
And last question here, quickly, what are some of the biggest challenges that consumers are up against right now when it comes to your consumer who seems to be willing to splurge on the blow dryers and the Ninja Creamy and so on?
Well, look, I mean, they have to make trade-offs and they have to make decisions, and they have to, do their research before. I mean, we think that a Shark Ninja consumer is an educated consumer. I mean, somebody who's done their research. We're not the highest priced products in the market. We're not the lowest priced products, but we think we move the opening price consumer up into our brands, but we're also the brand of choice for premium consumers. And so I think if we can continue on this model of great value, great quality, great performance, bringing exciting things to the consumer, I think they'll respond.
Thank you, Brooke DePalma, for bringing us that interview. Coming up, Getting Retirement Ready, we're bringing you part of Yahoo Finance's new podcast, Decoding Retirement, hosted by America's definitive voice on retirement, Robert Powell. Our debut episode features award-winning author and retirement expert Ann Lester. Stay tuned.
It's a jam-packed hour focusing on the biggest movers and shakers on Wall Street.
This is market domination, and here, every day is game day.
We have 1 hour left until the market close.
It's game time for investors to make their final plays.
The clock is ticking, and we've got you covered with our quarter-by-quarter playbook.
We're bringing you in on all the market action,
with step-by-step analysis of our biggest trending tickers
and expert insight into the day's biggest headlines.
We'll bring you the closing bell and get you to the finish line.
This is
Market Domination. Tune in daily from 3 to 4 p.m. Eastern.
How much should you have saved for retirement? Well, that's the question we're going to answer on today's episode of Decoding Retirement. Hi, I'm Bob Powell, and today we'll be talking with Ann Lester, who is author of Your Best Financial Life. Ann, welcome.
Thanks for having me.
Oh, it's a pleasure. So one of the things that we aim to do on Decoding Retirement is to go behind the headlines. And I want to share with you some headlines that came out recently. It was a study by Fidelity Investments, and Fidelity, in essence, reported that Gen Z plan participants, 401k plan participants, had saved $11,300 in their 401k plan. Millennials had saved $59,800. And one of the interesting things about this survey to me is Fidelity and others, JP Morgan, T. Rowe Price, others have said there are certain savings targets that people should aim for. 1 times your salary by age 30, 3 times by age 40, 8 times by age 60, and 10 times by age 67. And when I look at the average salaries for Gen Z and millennials, what strikes me is that those asset amounts are way below targets. And I'm curious, one, your reaction to the survey, and also what's the actionable advice for people who may be behind the 8 ball?
Yeah, so I always want to approach these numbers with a tiny grain of salt. So one is averages hide a lot, right? So some people are saving nothing. Some people just started saving last week. Some people have been saving 10 or 15% of their salary since the day they started working, and they get the gold star. But let's just say that $11,000 number. If you are 30 years old, that means you should have saved $110,000. No, I'm doing that math wrong. If you earning $56,000 a year and you're 30 years old, you should have saved up $56,000, right? So that is a big gap from 11,000 to 56,000. So number one, the oldest Gen Zers are 27, so they got a little more time. Number two, there is a lot of job hopping happening with younger workers, and so, to what extent have those people worked for the same company for the entire time or rolled their money over into the new plan? So it's possible that those numbers may be slightly understating the amount people have actually saved. But I think the headline is probably right, like people should be saving more money.
Right. So I think about that. I have a daughter. She's changed jobs twice now and left her 401k at her former employer, did not roll it over to her new employer or into a IRA. So in that case, we're looking at perhaps this possibility that she does have 1 times her salary saved or so.
Just not all in one place.
Right. So I'm thinking if someone is in that case, it's far better for them to roll over their old 401k to their new employer.
If they can, that's always, I think, the right strategy.
Right. And if not, keep it at the old employer or move it to an IRA?
It depends, right? And I know we'll talk about this a little bit. I wrote a book recently, and I dive into a lot of these questions. And one of the things you need to think about is, the mental tax on, dealing with it, which is non-trivial. It's actually not super easy. I know there is a whole bunch of initiatives to make this easier, but we're not quite there yet. Number two, if your old plan is the fees are high, you may want to roll it out into an IRA. If the fees are very low, if you work for a very large company, it's very likely that you are paying very, very low fees, and it's probably better to leave it alone. But you got to do a little research to make that decision. The bottom line, though, is if you're leaving it in your own plan, it's safe. You just don't want to forget about it.
Right. So the important thing is if you have multiple accounts or one account, to use these benchmarks 1 times your income at age 30?
Absolutely. I think that's a really good rule of thumb. It's, when you get closer to retirement, if you're in your 50s or 60s, you might want to start digging in a lot more to these general rules of thumb. But certainly in your 20s, 30s, and 40s, I think those are very practical sort of ways to gauge whether or not you're kind of roughly on track.
Yeah. And what about if someone's behind the 8 ball? So they have 11,000 saved, they need to have 56, increase their contribution rate, spend less.
All of the above. So most people are not saving quite enough, right? And Gen Zers are actually, out of all the generations, when you look at the data, doing a better job of being closer to what we think people should have. because more Gen Zers are getting automatically enrolled in plans, and this is a fairly recent trend, but more employers are starting to automatically escalate their contributions or increase them. If you've been automatically enrolled into a plan at 3% of your salary, that's a great place to start, but it's a terrible place to stop. You really need to be targeting 10 to 15% of your salary over time. The trick is you don't need to try to get there all at once. So if, let's say you're 25, you're earning $50,000 a year, and I'm telling you, yeah, you should try to save $5,000 to $7,000 of your salary. You're going to tell me to jump in the lake, right? So how do you get there from here? Well, you don't try to get there all in one go. What you do is borrow a trick from the Nobel Prize winners who came up with Save More Tomorrow, and that means you make a very strict commitment to yourself today that the next time you get a raise, which will hopefully be in 3 or 4 months at year end, you will take half of that raise and direct it towards your long-term savings.
All right. So the common advice, though, is for people to take advantage of the full employer match. And oftentimes that means contributing 6% in order to get 3% extra, which puts you at 9%.
I think that is 100% directionally where you need to be. The question is, if you are starting out and you're in your early 20s and you're living in a city that is expensive, that's just really hard to get there. And I guess the thing I want people to take away is you need to have that as your goal to get there. You don't have to start there if you're still trying to figure out how to balance your checkbook. Like don't set this incredibly high bar, fail, and then say this is never going to work, I give up, right? Make it a plan. How am I going to get from where I am today to where I need to be in a year?
All right,
and
so
then you step into that gradually.
So we can throw out the ramen noodle diet for now?
Well, if that's what you need to do to stay out of a debt, you need to be eating ramen noodles. But the next time you get a raise, you can take a little bit of that money and upgrade from the ramen noodles and also save more.
Yeah. So when I think about debt, I think a lot of these younger workers are only, they're two things. One is they're trying to save for retirement, which seems implausible when you're in your 20s, but also pay down student loan debt. Right. And that's a hard thing to do. You've got these two huge expenses.
Well, and rent. Let's not forget rent. I mean, it's a lot, right? So you're looking at, I think a lot of people starting out are you get your net paycheck, right? You've paid your payroll taxes, you've paid your income tax, you've paid for your health insurance, and what's left is already 60 to 70% of what you thought you were going to get, right? So that's already a little math. Then you pay for your rent, and then you pay for your student loans. Then with what you've got left, you need to create an emergency savings fund and save for retirement. So again, starting out, first job out of college, I think it's very unrealistic to expect people to be able to save 10 to 15%. So all I'm saying is start slow, start immediately. In the course of 3 or 4 years, you should be planning on building up that percentage that you're saving until you get to that 10 to 15%. And I think that is very doable for many people,
right.
Most people even.
So if someone does have student debt, I'm thinking, and especially because of Secure 2.0, some employers, not all, will match the amount that you're paying towards student loan debt.
Right. And that is, starting early for saving for retirement is the biggest gift you can give yourself, right? The power of compound returns is one of the biggest things most people don't get. So the dollar you save in your 20s is going to be worth, triple or quadruple that amount in your 50s and 60s. So it's really important to start early. If your employer matches, you should absolutely be taking advantage of that because that is free money.
Right. And if that's the case, would you suggest that they put all of their extra money toward paying down student debt or split it?
I think it's very important to have an emergency savings fund. I think that is absolutely critical. So I think if you have the opportunity to pay down your student loan debt and you have zero in emergency savings, you should be trying to do both of those. Once you have an emergency savings fund built up, then I think it's really important to take that money that you were saving for emergencies and throw it into your long-term savings, whether that's paying down debt and getting all of the match, or whether that's just starting to contribute money into the 401k plan as well. I think the question, right, about how much fun money do you give yourself is a really personal one. I am a walking example of someone who has been much more of a grasshopper than an ant. And I have never met something fun that I don't want to spend my money on. That's pretty true. So I struggle a little with that rule that says you should be, maximizing your saving from the get-go. I think if you feel poor and like you're missing out on things, it's a tough thing to feel. at the same time, you need to figure out how to pull your lifestyle down to a place where you're not increasing your debt burden, right? You don't want to be putting anything on credit cards. You don't want to be running up that debt. But I think, again, and I'm speaking especially when you're just starting out and you're at those very low salaries, you can expect fairly significant pay increases for the first sort of decade or two of your working career. And it is okay to let your lifestyle increase a little bit along with those increases in pay. The trick, though, is to not let your lifestyle completely eat up all of those raises. That's when you really want to boost your savings. So, like I said, I think you can start saving less in your early 20s and be targeting that 10 to 15% by the time you hit 30.
That was Robert Powell and Ann Lester on Yahoo Finance's debut episode of Decoding Retirement. And that's it for Wealth. I'm Brad Smith. Thanks so much for watching. Stay tuned for Market Domination with Julie Hyman and Josh Lipton. That comes up at 3 p.m. Eastern Time. They'll count you down to and through the closing bell. You don't want to miss it.